1. Introduction to oil prices. 1.1 The importance of oil prices. Oil prices play a crucial role in the global economy, impacting various sectors and influencing the daily lives of individuals around the world. The importance of oil prices stems from the fact that oil is a finite resource and a fundamental input in numerous industries, making it a critical driver of economic growth and development. This section will delve into the significance of oil prices and shed light on their far-reaching implications. Economic significance. Oil is a vital energy source that powers transportation, manufacturing, and other key sectors of the economy. As such, fluctuations in oil prices have a direct impact on the cost of production and transportation, which can significantly affect the overall cost structure of businesses. When oil prices rise, companies often face higher expenses, leading to increased production costs and reduced profit margins. This, in turn, can lead to higher prices for goods and services, potentially fueling inflationary pressures. Moreover, oil prices have a profound influence on consumer spending patterns. As the cost of fuel rises, households may have to allocate a larger portion of their budget to meet their energy needs, leaving less disposable income for other goods and services. This can dampen consumer demand and have a ripple effect on various industries, including retail, tourism, and hospitality. Geopolitical implications. Oil is not evenly distributed across the globe, with a few countries possessing significant reserves. This concentration of oil resources creates geopolitical dynamics that can impact global stability and security. Countries with abundant oil reserves often have significant influence in international affairs, as their oil wealth provides them with economic and political leverage. Disruptions in oil supply due to geopolitical conflicts, wars, or sanctions can lead to price spikes and supply shortages in the global oil market. For instance, conflicts in oil-producing regions such as the Middle East or disruptions in major shipping routes can disrupt the flow of oil and create uncertainty in the market. These geopolitical factors can have far-reaching consequences, affecting not only oil prices but also global economic stability and political relationships between nations. Environmental considerations. The importance of oil prices extends beyond economic and geopolitical realms to environmental concerns. Oil extraction, refining, and consumption contribute to greenhouse gas emissions and environmental degradation. As the world grapples with the challenges of climate change, the price of oil becomes a critical factor in shaping environmental policies and promoting sustainable energy alternatives. Higher oil prices can incentivize the development and adoption of renewable energy sources, such as solar, wind, and hydroelectric power. As the cost of oil rises, alternative energy becomes more economically viable, leading to increased investment and innovation in the renewable energy sector. This shift towards cleaner energy sources can help reduce carbon emissions and mitigate the environmental impact of oil consumption. Financial market impact. Oil prices have a significant impact on financial markets, particularly commodity markets and currencies. The price of oil is closely monitored by investors and traders, as it is considered a barometer of global economic health. Fluctuations in oil prices can trigger volatility in commodity markets, affecting the prices of other raw materials and commodities. Moreover, oil price movements can influence currency exchange rates, especially for countries heavily reliant on oil exports. When oil prices rise, countries exporting oil experience increased revenue, leading to a strengthening of their currency. Conversely, a decline in oil prices can weaken the currency of oil exporting nations, impacting their trade balance and overall economic stability. Social implications. Oil prices can have social implications, particularly in developing countries where access to affordable energy is crucial for basic needs and economic development. Higher oil prices can disproportionately affect low-income households, as they spend a larger proportion of their income on energy-related expenses. This can exacerbate income inequality and hinder poverty alleviation efforts. Furthermore, oil price volatility can create uncertainty and instability in oil-dependent economies. Sudden price fluctuations can disrupt government budgets, leading to fiscal challenges and potential social unrest. Developing countries heavily reliant on oil revenues may struggle to diversify their economies and reduce their dependence on oil, making them vulnerable to economic shocks caused by oil price fluctuations. In conclusion, the importance of oil prices cannot be overstated. They have far-reaching implications for the global economy, geopolitics, the environment, financial markets, and society as a whole. Understanding the dynamics of oil prices is crucial for policymakers, businesses, and individuals alike, as it allows for informed decision-making and proactive measures to mitigate the impacts of oil price volatility. 1.2 Factors affecting oil prices. Oil prices are influenced by a multitude of factors that can be categorized into several key areas. These factors include supply and demand dynamics, geopolitical events, economic conditions, financial market activities, environmental concerns, transportation sector developments, and government policies. Understanding these factors is crucial for comprehending the complexities of oil price fluctuations and their impact on various aspects of the global economy. In this section, we will explore each of these factors in detail. Supply and demand dynamics. One of the primary factors affecting oil prices is the balance between supply and demand. The availability of oil and the level of global consumption play a significant role in determining the price of this crucial commodity. When demand exceeds supply, prices tend to rise, and when supply outpaces demand, prices tend to fall. Several factors influence the supply side of the equation. These include the production levels of major oil-producing countries, technological advancements in extraction methods, exploration and drilling activities, and the availability of spare production capacity. Any disruptions in the supply chain, such as geopolitical conflicts, natural disasters, or infrastructure failures, can also impact oil prices. On the demand side, economic growth, industrial activities, transportation needs, and population growth are key drivers. Emerging economies, such as China and India, have experienced rapid industrialization and urbanization, leading to increased oil consumption. Conversely, economic downturns or shifts towards renewable energy sources can reduce oil demand, putting downward pressure on prices. Geopolitical events. Geopolitical events and conflicts in oil-producing regions can have a significant impact on oil prices. Political instability, wars, and civil unrest in major oil-producing countries can disrupt production and supply chains, leading to price volatility. For example, conflicts in the Middle East, such as the Iran-Iraq War or the Arab Spring, have historically caused oil price spikes due to concerns over supply disruptions. Sanctions and embargoes imposed on oil-producing countries can also affect oil prices. When major oil-producing nations face restrictions on their exports, global supply decreases, leading to higher prices. Conversely, the lifting of sanctions can result in increased supply and lower prices. Geographical challenges, such as remote or politically unstable regions, can also impact oil prices. Exploration and production in these areas often require higher costs and face greater risks, which can influence the overall supply and pricing dynamics. Economic conditions. Economic conditions, both globally and within individual countries, play a crucial role in determining oil prices. Economic growth rates, inflation levels, currency exchange rates, and interest rates can all influence the demand for oil and its affordability. During periods of robust economic growth, demand for oil tends to increase as industries expand and consumer spending rises. Conversely, economic downturns can lead to reduced oil demand as businesses cut back on production and consumers reduce their spending. Inflation can also impact oil prices. When inflation rates rise, the purchasing power of currencies decreases, making oil more expensive. Additionally, fluctuations in currency exchange rates can affect oil prices, especially for countries that import or export significant amounts of oil. A weaker domestic currency can increase the cost of imported oil, leading to higher prices for consumers. Interest rates set by central banks can also influence oil prices indirectly. Higher interest rates can slow down economic growth, reducing oil demand and putting downward pressure on prices. Conversely, lower interest rates can stimulate economic activity and increase oil consumption. Financial market activities. Financial markets, including commodity markets and speculative trading, can have a significant impact on oil prices. Commodity markets provide a platform for buying and selling oil futures contracts, which allow market participants to speculate on future price movements. Speculative trading in oil futures and options can lead to increased price volatility. Traders and investors who anticipate price movements based on various factors, such as supply and demand imbalances or geopolitical events, can influence short-term price fluctuations. However, it is important to note that speculation alone cannot sustain long-term price trends, as fundamental supply and demand factors ultimately determine oil prices. Financial instruments, such as exchange-traded funds (ETFs) and index funds, can also impact oil prices indirectly. These investment vehicles allow investors to gain exposure to the oil market without physically owning the commodity. Large inflows or outflows of capital into these funds can affect oil prices by creating artificial demand or supply pressures. Environmental concerns. Environmental factors, including regulations, renewable energy developments, carbon pricing, and public perception, can influence oil prices. Governments around the world have implemented regulations to reduce greenhouse gas emissions and promote cleaner energy sources. These regulations can increase the cost of oil production and consumption, potentially leading to higher prices. The growth of renewable energy sources, such as solar and wind power, can also impact oil prices. As the share of renewable energy in the global energy mix increases, the demand for oil may decline, putting downward pressure on prices. Additionally, advancements in battery technology and electric vehicles can reduce the dependence on oil in the transportation sector, further affecting oil demand and prices. Carbon pricing mechanisms, such as carbon taxes or emissions trading schemes, can also influence oil prices. These mechanisms aim to internalize the environmental costs of carbon emissions, making fossil fuels, including oil, more expensive relative to cleaner alternatives. Public perception and consumer behavior towards environmental issues can also impact oil prices indirectly. Increased awareness and concerns about climate change may lead to changes in consumer preferences, favoring environmentally friendly products and reducing oil demand. Transportation sector developments. The transportation sector is a significant consumer of oil, and developments in this sector can affect oil prices. The adoption of alternative fuels, such as natural gas, biofuels, or hydrogen, can reduce the demand for oil, potentially leading to lower prices. Government policies and incentives to promote alternative fuels can accelerate this transition. The rise of electric vehicles (EVs) is another important development that can impact oil prices. As EV technology improves and becomes more affordable, the demand for oil in the transportation sector may decline. However, the pace of EV adoption and the availability of charging infrastructure will play a crucial role in determining the extent of this impact. Infrastructure developments, such as the expansion of pipelines, refineries, or storage facilities, can also influence oil prices. Insufficient infrastructure can lead to supply bottlenecks and price volatility, especially in regions where production is geographically distant from consumption centers. Government policies. Government policies, including energy subsidies, taxation, energy security measures, and strategic reserves, can have a significant impact on oil prices. Energy subsidies, such as fuel subsidies, can artificially lower the cost of oil for consumers, reducing the price impact of global market fluctuations. Conversely, the removal or reduction of subsidies can expose consumers to higher oil prices. Taxation policies, including excise taxes or value-added taxes, VAT, can also affect oil prices. Higher taxes on oil products can increase their cost, leading to higher prices for consumers. Additionally, governments may use taxes as a tool to influence consumption patterns and promote energy efficiency. Energy security measures, such as diversification of energy sources or strategic alliances with oil-producing countries, can help stabilize oil prices by reducing supply disruptions. Strategic reserves, maintained by governments or international organizations, can be released during times of supply shortages to mitigate price spikes. Understanding the factors that influence oil prices is essential for policymakers, industry participants, and consumers alike. By analyzing these factors and their interplay, we can gain insights into the dynamics of oil prices and make informed decisions regarding energy consumption, investment strategies, and policy formulation. 1.3 Historical trends in oil prices. Understanding the historical trends in oil prices is crucial for comprehending the dynamics of this volatile commodity. Oil prices have experienced significant fluctuations over the years, influenced by various factors such as supply and demand dynamics, geopolitical events, economic conditions, and financial market speculation. This section will delve into the historical trends in oil prices, highlighting key periods and events that have shaped the oil market. Early years and the rise of oil prices. The history of oil prices can be traced back to the late 19th century when the oil industry began to emerge. Initially, oil prices were relatively stable due to limited global demand and production. However, with the advent of the automobile industry and the increasing reliance on oil for transportation, the demand for oil skyrocketed, leading to a surge in prices. One of the most significant events in the early years of the oil industry was the formation of the Organization of the Petroleum Exporting Countries (OPEC) in 1960. OPEC, comprised of major oil-producing nations, aimed to coordinate and stabilize oil prices. In the 1970s, OPEC implemented a series of oil embargoes, leading to a sharp increase in oil prices. The 1973 oil crisis, triggered by the Arab-Israeli conflict, resulted in a quadrupling of oil prices, causing a global economic downturn. Volatility and price shocks. The 1980s witnessed a period of oil price volatility, primarily driven by geopolitical tensions and economic factors. The Iran-Iraq War and the Iran hostage crisis in the late 1970s and early 1980s disrupted oil supplies, leading to price spikes. Additionally, global economic recessions, such as the one in the early 1980s, dampened oil demand, causing prices to plummet. The 1990s marked another significant period in oil price history. The Gulf War in 1990–1991 resulted in a brief spike in oil prices, followed by a period of relative stability. However, in the late 1990s, oil prices experienced a sharp decline due to a combination of factors, including a slowdown in global economic growth and increased oil production from non-OPEC countries. The 2000s, soaring prices and the global financial crisis. The early 2000s witnessed a steady increase in oil prices, driven by robust global economic growth, particularly in emerging markets like China and India. The rapid industrialization and increased energy consumption in these countries led to a surge in oil demand, pushing prices to new heights. In 2008, oil prices reached an all-time high of around $147 per barrel. However, the global financial crisis in 2008 had a profound impact on oil prices. As the crisis unfolded, global demand for oil plummeted, leading to a sharp decline in prices. By the end of 2008, oil prices had fallen to around $30 per barrel. The subsequent years saw a period of volatility, with prices fluctuating due to a combination of economic uncertainty, geopolitical tensions, and supply-demand imbalances. Recent trends and the impact of COVID-19. In recent years, oil prices have been influenced by a range of factors, including geopolitical events, production cuts by OPEC and its allies, and shifts in global energy markets. The rise of shale oil production in the United States has also had a significant impact on oil prices, as it has increased global oil supplies and reduced OPEC's market share. The COVID-19 pandemic, which emerged in late 2019, had a profound impact on oil prices. As countries implemented lockdown measures and travel restrictions, global oil demand plummeted, leading to a historic collapse in prices. In April 2020, oil prices briefly turned negative for the first time in history, as storage capacity became scarce and traders were willing to pay to offload their contracts. Since then, oil prices have shown some signs of recovery as economies gradually reopen and demand begins to rebound. However, the long-term impact of the pandemic on oil prices remains uncertain, as structural changes in energy consumption patterns and the push for renewable energy sources could reshape the oil market in the coming years. Conclusion. Understanding the historical trends in oil prices provides valuable insights into the complex dynamics of this crucial commodity. From the early years of stability to the volatility and price shocks of the 20th century, oil prices have been influenced by a myriad of factors. The recent impact of the COVID-19 pandemic serves as a reminder of the vulnerability of oil prices to unforeseen events. As the world transitions towards a more sustainable energy future, the future of oil prices remains uncertain, with geopolitical shifts and technological advancements likely to play a significant role in shaping the oil market. 1.4 The role of speculation in oil prices. Speculation plays a significant role in the dynamics of oil prices. It refers to the practice of buying and selling oil contracts with the expectation of making a profit from price fluctuations. Speculators, including hedge funds, investment banks, and individual traders, participate in the oil market to take advantage of potential price movements. The motivation behind speculation. Speculators are driven by various factors when entering the oil market. One primary motivation is the potential for profit. By correctly predicting future oil price movements, speculators can generate substantial returns on their investments. Additionally, speculation provides liquidity to the market, allowing for efficient price discovery and risk management. Impact on price volatility. Speculation can contribute to increased price volatility in the oil market. When speculators enter the market, they introduce additional buying or selling pressure, which can amplify price movements. This effect is particularly evident in short-term trading, where speculators aim to profit from rapid price fluctuations. As a result, oil prices can experience sharp and sudden changes, leading to increased volatility. Controversy and criticism. The role of speculation in oil prices has been a subject of controversy and criticism. Some argue that excessive speculation can distort prices and lead to market inefficiencies. Critics claim that speculators, driven by profit motives, can artificially inflate or deflate oil prices, causing economic instability and harming consumers and businesses. However, it is important to note that speculation alone cannot sustain a long-term trend in oil prices. Ultimately, the fundamentals of supply and demand dictate the overall price direction. Speculation may influence short-term price movements, but it cannot override the underlying market forces. Speculation and market efficiency. Proponents of speculation argue that it enhances market efficiency by providing valuable information and improving price discovery. Speculators analyze various factors, such as geopolitical events, economic indicators, and supply and demand dynamics, to make informed trading decisions. Their actions reflect market expectations and can help reveal valuable insights about future oil price trends. Furthermore, speculation can act as a risk management tool for market participants. Hedging strategies, commonly employed by producers, consumers, and traders, involve taking offsetting positions in the futures market to protect against adverse price movements. Speculators provide the necessary liquidity for these hedging activities, allowing market participants to manage their exposure to oil price risk effectively. Regulation of speculation. Given the potential impact of speculation on oil prices, regulatory authorities have implemented measures to monitor and control speculative activities. These regulations aim to prevent excessive speculation that could disrupt market stability and harm the broader economy. One approach to regulation is imposing position limits, which restrict the number of contracts that speculators can hold. Position limits help prevent market manipulation and excessive concentration of positions by individual traders or entities. Additionally, regulatory authorities closely monitor trading activities and investigate any potential market abuses or manipulations. The debate on speculation. The role of speculation in oil prices remains a topic of ongoing debate. While some argue that speculation contributes to price volatility and market inefficiencies, others contend that it enhances market efficiency and provides valuable liquidity. The impact of speculation on oil prices is complex and influenced by various factors, including market conditions, investor behavior, and external events. It is crucial to strike a balance between allowing speculation to facilitate market functioning and implementing appropriate regulations to prevent excessive speculation. Stricter oversight and transparency in the oil market can help mitigate potential risks associated with speculative activities while ensuring fair and efficient price discovery. In conclusion, speculation plays a significant role in the dynamics of oil prices. It can contribute to increased price volatility and market efficiency simultaneously. While controversy and criticism surround the impact of speculation on oil prices, it is essential to recognize that speculation alone cannot sustain long-term price trends. Understanding the role of speculation in oil prices is crucial for market participants, policymakers, and consumers alike. 2. Supply and demand dynamics. 2.1 Oil supply and production. Oil supply and production play a crucial role in determining the dynamics of oil prices. The availability of oil in the market and the ability of producers to extract and refine it directly impact the overall supply and, consequently, the price of oil. In this section, we will delve into the factors that influence oil supply and production and explore their implications for oil prices. Global oil reserves. Oil reserves refer to the estimated amount of oil that can be technically and economically extracted from the ground. These reserves are distributed across various countries and regions worldwide. The size and accessibility of these reserves significantly affect the global oil supply and, consequently, the price of oil. The Organization of the Petroleum Exporting Countries, OPEC, is a major player in the global oil market, as its member countries collectively possess significant oil reserves. OPEC's decisions regarding production levels have a substantial impact on oil prices. When OPEC countries reduce production, the global oil supply decreases, leading to a potential increase in oil prices. Conversely, when OPEC countries increase production, the global oil supply rises, which can put downward pressure on oil prices. Production capacity and technology. The ability of oil-producing countries and companies to extract and refine oil depends on their production capacity and technological advancements. Higher production capacity allows for increased oil output, which can help meet growing global demand and stabilize oil prices. Technological advancements, such as improved drilling techniques and enhanced recovery methods, can also contribute to increased production efficiency and the extraction of previously inaccessible oil reserves. However, there are limitations to production capacity and technology. Some oil-producing regions may face infrastructure constraints, political instability, or geographical challenges that hinder their ability to maximize production. Additionally, the cost of implementing advanced technologies can impact the profitability of oil production, potentially influencing supply levels and, consequently, oil prices. Exploration and discoveries. Exploration efforts and new oil discoveries are critical in maintaining and expanding global oil reserves. Exploration involves the search for new oil fields and the assessment of their potential production capacity. Successful exploration can lead to the discovery of untapped oil reserves, which can increase the global oil supply and potentially alleviate upward pressure on oil prices. However, the process of exploration and discovery is not without challenges. It requires significant investments in research, technology, and infrastructure. Moreover, the success rate of exploration activities can vary, and not all exploration efforts result in significant discoveries. The uncertainty surrounding exploration outcomes adds an element of unpredictability to future oil supply levels and, consequently, oil prices. Political and geopolitical factors. Political and geopolitical factors can significantly impact oil supply and production. Political instability, conflicts, and wars in oil-producing regions can disrupt oil extraction and transportation, leading to supply disruptions and potential price spikes. For example, conflicts in the Middle East, such as the Iran-Iraq War and the Gulf War, have historically caused oil price volatility due to concerns over supply disruptions. Moreover, geopolitical tensions between major oil-producing countries can also influence oil prices. Disputes over territory, resources, or political ideologies can lead to production disruptions or export restrictions, affecting global oil supply and prices. The relationship between major oil-producing countries, such as the United States, Russia, and Saudi Arabia, can have a significant impact on the stability of the global oil market. Environmental considerations. Environmental concerns and regulations also play a role in shaping oil supply and production. Increasing awareness of climate change and the need to reduce greenhouse gas emissions have led to stricter environmental regulations on oil extraction and refining processes. These regulations can impose additional costs on oil producers, potentially affecting their profitability and, consequently, oil supply levels. Furthermore, the growing interest in renewable energy sources and the transition towards a more sustainable energy mix can impact the demand for oil and, consequently, its price. As renewable energy technologies become more cost-effective and accessible, the demand for oil may decline, putting downward pressure on oil prices. In conclusion, oil supply and production are critical factors that influence the dynamics of oil prices. The size and accessibility of global oil reserves, production capacity and technology, exploration efforts, political and geopolitical factors, and environmental considerations all contribute to the overall supply of oil and, consequently, its price. Understanding these factors is essential for comprehending the complexities of oil markets and predicting future oil price trends. 2.2 Oil demand and consumption. Oil demand and consumption play a crucial role in determining the dynamics of oil prices. The level of demand for oil is influenced by various factors, including economic growth, population growth, industrialization, transportation needs, and government policies. Understanding the patterns and drivers of oil demand is essential for comprehending the fluctuations in oil prices. Factors influencing oil demand. Economic growth. Economic growth is a significant driver of oil demand. As economies expand, there is an increased need for energy to power industries, transportation, and households. Developing countries, in particular, experience rapid economic growth, leading to a surge in oil consumption. Conversely, during economic downturns, such as recessions, oil demand tends to decline as industries scale back production and consumers reduce their spending. Population growth. The size and growth rate of the global population also impact oil demand. As the population increases, so does the need for energy to meet the rising demands of transportation, housing, and other sectors. Additionally, population growth often accompanies urbanization, which further drives up oil consumption due to increased commuting and transportation needs. Industrialization. The level of industrialization in a country or region has a direct impact on oil demand. Industrial activities, such as manufacturing, construction, and mining, require significant amounts of energy, much of which is derived from oil. As countries industrialize and their manufacturing sectors expand, the demand for oil rises accordingly. Transportation sector. The transportation sector is one of the largest consumers of oil globally. The demand for oil in this sector is influenced by factors such as the number of vehicles on the road, the distance traveled, and the fuel efficiency of vehicles. As the number of cars, trucks, and airplanes increases, so does the demand for oil. However, advancements in fuel efficiency and the adoption of alternative fuels can mitigate the growth in oil consumption in the transportation sector. Government policies. Government policies and regulations can significantly impact oil demand. For instance, policies promoting the use of renewable energy sources, such as wind and solar power, can reduce the reliance on oil for electricity generation. Additionally, fuel efficiency standards for vehicles and incentives for electric vehicles can help curb oil consumption in the transportation sector. Conversely, policies that subsidize oil consumption or limit the availability of alternative energy sources can increase oil demand. Regional variations in oil demand. Oil demand varies across different regions of the world due to variations in economic development, population growth, and government policies. Here are some key regional trends in oil demand. Developed economies. Developed economies, such as the United States, Europe, and Japan, have relatively mature economies and exhibit slower growth rates in oil demand. This is partly due to the implementation of energy efficiency measures, stricter environmental regulations, and a shift towards cleaner energy sources. However, these regions still account for a significant share of global oil consumption. Emerging economies. Emerging economies, including China, India, and Brazil, have experienced rapid industrialization and urbanization, leading to substantial growth in oil demand. These countries have large populations and rising middle classes, which drive increased energy consumption for transportation, manufacturing, and residential purposes. As these economies continue to develop, their demand for oil is expected to rise further. Middle East. The Middle East is a major oil-producing region, but it also has a significant domestic demand for oil due to its growing population and industrialization. The region's oil consumption is driven by factors such as rapid urbanization, increased vehicle ownership, and energy-intensive industries. Africa. Africa has a diverse range of economies, with some countries experiencing rapid economic growth and others facing challenges. The demand for oil in Africa is influenced by factors such as population growth, urbanization, and the development of infrastructure. However, the continent also has significant potential for renewable energy sources, which could help reduce its reliance on oil in the future. Future trends in oil demand. The future of oil demand is subject to various uncertainties and potential disruptions. While the long-term trajectory of oil demand will depend on factors such as technological advancements, government policies, and societal preferences, several trends are worth noting. Energy transition. The global shift towards cleaner and more sustainable energy sources, driven by concerns about climate change and environmental sustainability, is likely to impact oil demand. The increasing adoption of renewable energy, electric vehicles, and energy-efficient technologies could lead to a decline in oil consumption, particularly in the transportation sector. Technological advancements. Technological advancements, such as improvements in battery storage, hydrogen fuel cells, and carbon capture and storage, could influence the future demand for oil. These innovations have the potential to reduce the reliance on oil in various sectors, including transportation and electricity generation. Government policies. Government policies aimed at reducing greenhouse gas emissions and promoting renewable energy will play a crucial role in shaping future oil demand. The implementation of carbon pricing mechanisms, subsidies for renewable energy, and stricter fuel efficiency standards can accelerate the transition away from oil. Changing consumer behavior. Consumer preferences and behavior can also impact oil demand. Increasing awareness of environmental issues and a growing preference for sustainable products and services may lead to a shift in consumer choices, favoring alternatives to oil. In conclusion, oil demand and consumption are influenced by a range of factors, including economic growth, population growth, industrialization, transportation needs, and government policies. Understanding these factors and their regional variations is essential for comprehending the dynamics of oil prices. The future of oil demand is likely to be shaped by the energy transition, technological advancements, government policies, and changing consumer behavior. 2.3 OPEC and its influence on oil prices. The Organization of the Petroleum Exporting Countries, OPEC, is a prominent and influential intergovernmental organization that plays a significant role in the global oil market. Comprised of 13 member countries, OPEC collectively controls a substantial portion of the world's oil reserves and production. As a result, OPEC's decisions and actions have a considerable impact on oil prices worldwide. OPEC's formation and objectives. OPEC was founded in 1960 by 5 oil-producing countries: Iran, Iraq, Kuwait, Saudi Arabia, and Venezuela. Over the years, it has expanded to include 8 additional member countries: Algeria, Angola, Ecuador, Equatorial Guinea, Gabon, Libya, Nigeria, and the Republic of the Congo. Together, these nations account for approximately 80% of the world's proven oil reserves. The primary objective of OPEC is to coordinate and unify the petroleum policies of its member countries to ensure stable oil markets and secure fair prices for both producers and consumers. OPEC aims to achieve this by managing oil production levels and adjusting output quotas to balance supply and demand dynamics. Production quotas and output adjustments. One of the most significant ways in which OPEC influences oil prices is through its production quotas and output adjustments. OPEC member countries collectively determine the overall production target for the organization, which is then divided among the individual member countries based on their respective production capacities and reserves. When oil prices are low, OPEC often implements production cuts to reduce the global supply of oil and increase prices. Conversely, during periods of high prices, OPEC may increase production to meet growing demand and stabilize prices. These production adjustments are typically agreed upon during OPEC meetings, where member countries negotiate and decide on the appropriate course of action. OPEC's market power and price influence. OPEC's market power stems from its significant share of global oil reserves and production capacity. By collectively controlling a substantial portion of the world's oil supply, OPEC can exert influence over oil prices. When OPEC announces production cuts or increases, it sends a strong signal to the market, impacting expectations and subsequently affecting prices. OPEC's ability to influence prices is further enhanced by its dominant role in the global oil trade. Many countries heavily rely on OPEC member countries for their oil imports, making them vulnerable to any supply disruptions or price fluctuations caused by OPEC's decisions. As a result, OPEC's actions can have far-reaching consequences for both oil importing and oil exporting nations. OPEC's relationship with non-OPEC producers. While OPEC plays a crucial role in shaping oil prices, it is important to consider the influence of non-OPEC oil-producing countries as well. Non-OPEC producers, such as the United States, Russia, Canada, and Brazil, also contribute significantly to global oil production. Their actions and production levels can impact oil prices independently of OPEC's decisions. In recent years, the rise of shale oil production in the United States has disrupted traditional market dynamics and challenged OPEC's influence. The increased production from non-OPEC countries has added to the global oil supply, potentially offsetting OPEC's efforts to stabilize prices through production cuts. OPEC's challenges and future outlook. OPEC faces several challenges that impact its ability to control oil prices effectively. One significant challenge is the differing interests and priorities among its member countries. Each member has its own economic and political considerations, which can sometimes lead to disagreements and difficulties in reaching consensus on production quotas and output adjustments. Additionally, the global transition towards renewable energy sources and efforts to combat climate change pose long-term challenges for OPEC. As countries shift towards cleaner and more sustainable energy alternatives, the demand for oil may decline, potentially affecting OPEC's market power and its ability to influence prices. Despite these challenges, OPEC remains a crucial player in the global oil market. Its decisions and actions continue to shape oil prices, particularly in the short to medium term. As the world's energy landscape evolves, OPEC will need to adapt and navigate the changing dynamics to maintain its relevance and influence in the future. 2.4 Non-OPEC producers and their impact on oil prices. Non-OPEC Organization of the Petroleum Exporting Countries producers play a significant role in the global oil market and have a considerable impact on oil prices. While OPEC is often seen as the dominant force in determining oil prices, non-OPEC producers contribute to the overall supply and demand dynamics that influence price fluctuations. In this section, we will explore the key non-OPEC producers and their impact on oil prices. The rise of non-OPEC producers. Over the past few decades, non-OPEC producers have emerged as major players in the global oil market. These countries, including the United States, Canada, Russia, Brazil, and China, have significantly increased their oil production capacities, challenging the traditional dominance of OPEC. The rise of non-OPEC producers has been driven by advancements in technology, such as hydraulic fracturing, fracking, and horizontal drilling, which have unlocked previously inaccessible oil reserves. United States, shale revolution and its influence. The United States has experienced a shale revolution, primarily driven by the development of unconventional oil and gas resources. The exploitation of shale formations, particularly in the Permian Basin and the Bakken Formation, has led to a substantial increase in U.S. oil production. The surge in U.S. shale oil production has not only reduced the country's dependence on oil imports but also had a profound impact on global oil prices. The increased production from U.S. shale oil has added to the global oil supply, leading to a shift in the supply-demand balance. As a result, oil prices have become more sensitive to changes in non-OPEC production, particularly from the United States. When U.S. production increases, it can put downward pressure on oil prices, as the market becomes more oversupplied. Conversely, any disruptions or declines in U.S. production can lead to price increases due to reduced supply. Canada, oil sands and heavy crude production. Canada is another significant non-OPEC producer, known for its vast oil sands reserves. Oil sands are a type of unconventional oil deposit that requires specialized extraction techniques, such as mining or in situ methods. Canada's oil sands production has steadily increased over the years, contributing to the global oil supply. The production of heavy crude oil from Canadian oil sands has its own dynamics and can have an impact on oil prices. Heavy crude oil typically sells at a discount compared to light crude oil due to its higher viscosity and lower quality. The availability and pricing of Canadian heavy crude can influence the overall price differentials between various grades of crude oil, affecting global oil prices. Russia, a major non-OPEC player. Russia is one of the world's largest oil producers and a significant non-OPEC player. The country's oil industry is dominated by state-owned companies, such as Rosneft and Gazprom, which have substantial production capacities. Russia's oil production levels can have a notable impact on global oil prices, especially considering its position as a major exporter. Political factors and geopolitical tensions involving Russia can also influence oil prices. Sanctions imposed on Russia by Western countries, for example, can disrupt its oil production and exports, leading to price fluctuations. Additionally, Russia's cooperation or lack thereof with OPEC in managing oil production levels can affect market sentiment and contribute to price volatility. Other non-OPEC producers. Apart from the United States, Canada, and Russia, several other non-OPEC producers contribute to the global oil market. Brazil, for instance, has significant offshore oil reserves and has been expanding its production capabilities. China, the world's largest energy consumer, has been increasing its domestic oil production to meet its growing demand. The production levels and policies of these non-OPEC producers, along with other factors like technological advancements, geopolitical developments, and market conditions, collectively shape the global oil market and influence oil prices. Conclusion. Non-OPEC producers have become increasingly influential in the global oil market, challenging the traditional dominance of OPEC. The rise of non-OPEC production, particularly from countries like the United States, Canada, and Russia, has significantly impacted oil prices. The increased supply from these producers has altered the supply-demand dynamics, making oil prices more sensitive to non-OPEC production levels. Understanding the role of non-OPEC producers is crucial for comprehending the complexities of oil price dynamics. Their production capacities, technological advancements, and geopolitical factors all contribute to the overall supply and demand balance, ultimately influencing oil prices on a global scale. As the global energy landscape continues to evolve, the influence of non-OPEC producers on oil prices is likely to remain a critical factor to consider. 3. Geopolitical factors and oil prices. 3.1 Political instability and oil prices. Political instability is one of the key factors that can significantly impact oil prices. The stability of oil-producing countries and regions plays a crucial role in determining the supply and availability of oil in the global market. Any disruptions or uncertainties in these regions can lead to price volatility and affect the overall dynamics of oil prices. Historical examples. Throughout history, political instability has been a major driver of oil price fluctuations. One notable example is the 1973 oil crisis, also known as the Arab oil embargo. During this period, several Arab nations imposed an oil embargo on countries that supported Israel in the Yom Kippur War. This led to a significant reduction in oil supply and a sharp increase in prices. The crisis highlighted the vulnerability of oil markets to geopolitical tensions and demonstrated how political instability can have a direct impact on oil prices. Another example is the Persian Gulf War in 1990. The invasion of Kuwait by Iraq resulted in a disruption of oil production and a subsequent spike in oil prices. The conflict created uncertainty in the region and raised concerns about the stability of oil supplies, leading to increased market volatility. Ongoing conflicts and unrest. Currently, several oil-producing regions are experiencing political instability and conflicts that have the potential to impact oil prices. The Middle East, particularly countries like Iraq, Syria, and Libya, has been plagued by ongoing conflicts and civil unrest. These conflicts have disrupted oil production and export capabilities, leading to supply disruptions and price fluctuations. In recent years, the civil war in Libya has significantly affected its oil production. The country's oil infrastructure has been targeted, resulting in frequent shutdowns and reduced output. The political instability in Libya has not only impacted its own oil production but has also had ripple effects on global oil prices. Similarly, the ongoing conflict in Syria has disrupted oil production and transportation routes, affecting the availability of oil in the region. The uncertainty surrounding the political situation in Syria has contributed to market volatility and price fluctuations. Sanctions and embargoes. Political tensions between countries can also result in the imposition of sanctions or embargoes on oil-producing nations. These measures restrict the ability of sanctioned countries to export oil, leading to reduced supply and higher prices. An example of this is the sanctions imposed on Iran by the United States and other countries. The sanctions targeted Iran's oil exports, limiting its ability to sell oil on the global market. As a result, global oil prices were affected, with concerns about potential supply shortages driving prices higher. Impact on oil companies and investments. Political instability can also have a significant impact on oil companies and investments in the sector. Uncertainty and unrest in oil-producing regions can lead to increased risks for companies operating in those areas. This can result in higher costs, reduced production, and potential disruptions to supply chains. Investors in the oil industry are also affected by political instability. The uncertainty created by political unrest can lead to increased market volatility and make it challenging to predict future oil prices. This can make investment decisions more difficult and potentially deter investment in the sector. Geopolitical risk premium. Political instability and conflicts in oil-producing regions often lead to the inclusion of a geopolitical risk premium in oil prices. This premium reflects the additional cost associated with the uncertainty and risks posed by political instability. Market participants factor in this risk premium when pricing oil contracts, which can contribute to higher oil prices. In conclusion, political instability is a significant factor that can impact oil prices. Historical examples, ongoing conflicts, sanctions, and the associated risks for oil companies and investments all contribute to the influence of political instability on oil prices. Understanding the dynamics of political instability and its potential effects on oil markets is crucial for analyzing and forecasting oil price movements. 3.2 Conflicts and wars in oil-producing regions. Conflicts and wars in oil-producing regions have a significant impact on oil prices. The geopolitical instability resulting from these conflicts can disrupt oil production, transportation, and supply, leading to price volatility in global oil markets. This section explores the relationship between conflicts and wars in oil-producing regions and their effects on oil prices. Historical perspective. Throughout history, conflicts and wars have frequently occurred in regions rich in oil reserves. The Middle East, in particular, has been a hotbed of geopolitical tensions and military conflicts due to its vast oil resources. The Arab-Israeli conflicts, the Iran-Iraq War, and the Gulf War are just a few examples of conflicts that have directly affected oil production and prices. Disruption of oil production. Conflicts and wars can disrupt oil production in several ways. Firstly, infrastructure such as oil fields, pipelines, and refineries can be damaged or destroyed during military operations. This physical destruction hampers the ability of oil-producing countries to extract, process, and transport oil, leading to a decrease in global oil supply. Secondly, conflicts often result in the displacement of workers and the disruption of labor markets. Skilled workers may flee the conflict zone, leaving a shortage of personnel with the necessary expertise to operate oil facilities effectively. This can further hinder oil production and contribute to supply disruptions. Transportation disruptions. Oil transportation is also vulnerable to conflicts and wars. Major shipping routes, such as the Strait of Hormuz and the Bab el-Mandeb Strait, are critical for the transportation of oil from the Middle East to global markets. These strategic choke points can become targets during conflicts, leading to disruptions in oil shipments and increased transportation costs. Furthermore, conflicts can lead to the imposition of sanctions or embargoes on oil-producing countries. These measures restrict the export of oil, limiting the availability of supply in the global market and driving up prices. Market sentiment and speculation. Conflicts and wars create an atmosphere of uncertainty and fear in the global oil market. Market participants, including traders, investors, and speculators, closely monitor geopolitical developments and assess their potential impact on oil supply and prices. This heightened market sentiment can lead to increased speculation, further exacerbating price volatility. Speculators may take positions based on their expectations of future supply disruptions or geopolitical tensions. Their actions can amplify price movements, leading to exaggerated price swings in response to even minor geopolitical events. OPEC and non-OPEC dynamics. Conflicts and wars in oil-producing regions can also influence the dynamics within OPEC, Organization of the Petroleum Exporting Countries, and its relationship with non-OPEC producers. OPEC member countries often have conflicting political interests and alliances, which can be exacerbated during times of regional conflicts. Conflicts can lead to disagreements among OPEC members regarding production levels and market share. Some countries may choose to increase production to compensate for supply disruptions in conflict-affected regions, while others may reduce output to maintain higher prices. These conflicting strategies can create tensions within OPEC and impact global oil prices. Non-OPEC producers, particularly those in politically stable regions, may benefit from conflicts in oil-producing regions. As supply from conflict-affected countries decreases, non-OPEC producers can increase their market share and influence global oil prices. Case study: Middle East conflicts. The Middle East has been a focal point of conflicts and wars that have had a profound impact on oil prices. The ongoing conflicts in Syria, Iraq, and Yemen have disrupted oil production and transportation routes in the region. Attacks on oil infrastructure, such as pipelines and refineries, have caused significant supply disruptions. Additionally, geopolitical tensions between Iran and other countries, including the United States, have led to the imposition of sanctions on Iran's oil exports. These sanctions have further reduced global oil supply and contributed to price volatility. Conclusion: conflicts and wars in oil-producing regions have a direct and significant impact on oil prices. Disruptions in oil production and transportation, market sentiment and speculation, and the dynamics within OPEC and non-OPEC producers all contribute to price volatility. Understanding the relationship between conflicts and oil prices is crucial for policymakers, market participants, and consumers to navigate the complex dynamics of the global oil market. 3.3 Sanctions and embargoes on oil-producing countries. Sanctions and embargoes on oil-producing countries have a significant impact on oil prices and the global oil market. These measures are often imposed by governments or international organizations as a means of exerting political pressure or addressing geopolitical concerns. The restrictions placed on oil-producing countries can disrupt the supply of oil, leading to price fluctuations and market volatility. The purpose of sanctions and embargoes. Sanctions and embargoes are political tools used to influence the behavior of targeted countries. They can be imposed for various reasons, including human rights violations, nuclear proliferation, support for terrorism, or aggression towards other nations. By restricting trade, including oil exports, these measures aim to isolate and pressure the targeted country to change its policies or behavior. Impact on oil supply. When sanctions or embargoes are imposed on oil-producing countries, the supply of oil in the global market is affected. The targeted country may face difficulties in exporting its oil, leading to a decrease in global oil supply. This reduction in supply can create a shortage in the market, driving up oil prices. For example, the sanctions imposed on Iran in recent years have significantly impacted its oil exports. As one of the largest oil producers in the world, Iran's reduced oil supply has contributed to global supply constraints and price increases. Similarly, embargoes on countries like Venezuela and Libya have also disrupted their oil production and exports, leading to supply disruptions and price volatility. Market reactions to sanctions and embargoes. The announcement or implementation of sanctions and embargoes can trigger immediate market reactions. Oil traders and investors closely monitor geopolitical developments and anticipate the potential impact on oil supply and prices. As a result, the anticipation of sanctions or embargoes can lead to price increases even before the actual restrictions are enforced. Furthermore, the effectiveness of sanctions and embargoes in achieving their intended goals can vary. In some cases, targeted countries may find alternative ways to bypass the restrictions and continue exporting oil. This can mitigate the impact on global oil supply and limit the price effects. Additionally, other oil-producing countries may increase their production to compensate for the reduced supply, further stabilizing the market. Geopolitical considerations. Sanctions and embargoes on oil-producing countries are not without geopolitical considerations. The imposition of these measures can have broader implications for regional stability and international relations. It can strain diplomatic relations between countries and lead to retaliatory actions or countermeasures. For example, when the United States imposed sanctions on Iran, it faced opposition from other countries that sought to maintain trade relations with Iran. This led to tensions between the United States and its allies, as well as strained relations with countries that continued to trade with Iran. These geopolitical dynamics can further complicate the impact of sanctions and embargoes on oil prices. Mitigating the impact. To mitigate the impact of sanctions and embargoes on oil prices, countries and organizations often take measures to ensure the stability of the global oil market. This can include releasing oil from strategic reserves, increasing production from unaffected countries, or seeking alternative sources of oil. International cooperation and coordination are crucial in managing the effects of sanctions and embargoes. Organizations like the International Energy Agency (IEA) play a vital role in monitoring global oil supply and coordinating emergency responses to supply disruptions. By working together, countries can minimize the volatility and potential economic disruptions caused by these measures. Conclusion. Sanctions and embargoes on oil-producing countries have a significant impact on oil prices and the global oil market. These measures disrupt the supply of oil, leading to price fluctuations and market volatility. The anticipation and announcement of sanctions can already affect oil prices, while the effectiveness of these measures can vary depending on geopolitical considerations and the ability of targeted countries to bypass restrictions. International cooperation and coordination are essential in managing the impact of sanctions and embargoes on oil prices and ensuring the stability of the global oil market. 3.4 Geographical challenges and their effect on oil prices. Geographical challenges play a significant role in shaping the dynamics of oil prices. The location of oil reserves, transportation infrastructure, and geopolitical tensions in oil-producing regions all contribute to the volatility and fluctuations in oil prices. In this section, we will explore the various geographical challenges and their effects on oil prices. 3.4.1 Location of oil reserves. The geographical distribution of oil reserves around the world has a direct impact on oil prices. Some countries, such as Saudi Arabia, Russia, and the United States, possess vast oil reserves, making them major players in the global oil market. The proximity of these reserves to major consumer markets affects transportation costs and supply chain logistics, which in turn influence oil prices. For instance, countries with oil reserves located near major shipping routes or pipelines can transport oil more efficiently and at a lower cost. This proximity reduces transportation expenses and ensures a steady supply of oil to consumer markets. On the other hand, countries with remote or landlocked oil reserves face higher transportation costs, which can lead to higher oil prices. 3.4.2 Transportation infrastructure. The availability and efficiency of transportation infrastructure are crucial factors in determining oil prices. Pipelines, ports, and shipping routes are essential for transporting oil from production sites to refineries and consumer markets. Any disruptions or limitations in this infrastructure can lead to supply shortages and price spikes. Geographical challenges such as rugged terrains, extreme weather conditions, or political instability can hinder the development and maintenance of transportation infrastructure. For example, conflicts in oil-producing regions like the Middle East or Africa can disrupt oil transportation routes, leading to supply disruptions and price volatility. Additionally, the lack of adequate infrastructure in certain regions can limit the ability to extract and transport oil efficiently. This can result in higher production costs and ultimately impact oil prices. Investments in infrastructure development, such as building new pipelines or expanding port capacities, can help mitigate these challenges and stabilize oil prices. 3.4.3 Geopolitical tensions in oil-producing regions. Geopolitical tensions in oil-producing regions have a significant impact on oil prices. Political instability, conflicts, and wars can disrupt oil production and transportation, leading to supply disruptions and price spikes. Oil-producing countries located in politically unstable regions are particularly vulnerable to these challenges. For example, the ongoing conflicts in the Middle East, particularly in countries like Iraq, Syria, and Libya, have resulted in significant disruptions to oil production and exports. These disruptions have led to supply shortages and increased oil prices globally. Geopolitical tensions can also lead to the imposition of sanctions or embargoes on oil-producing countries, further impacting oil prices. 3.4.4 Environmental vulnerabilities. Certain oil-producing regions are prone to environmental vulnerabilities, such as hurricanes, earthquakes, or other natural disasters. These events can damage oil infrastructure, disrupt production, and impact oil prices. For instance, hurricanes in the Gulf of Mexico have historically disrupted offshore oil production, leading to temporary supply shortages and price increases. Moreover, regions with fragile ecosystems or sensitive environments may face stricter environmental regulations, which can increase production costs and affect oil prices. The need for environmental protection and sustainability can lead to additional expenses for oil companies, which may be passed on to consumers in the form of higher oil prices. 3.4.5 Remote and challenging extraction sites. Some oil reserves are located in remote and challenging environments, such as deep-sea offshore fields or Arctic regions. Extracting oil from these sites requires advanced technology, specialized equipment, and significant investment. The high costs associated with exploration, production, and transportation from these challenging locations can impact oil prices. The exploration and development of remote oil reserves often involve complex logistical operations, including drilling in extreme conditions and transporting equipment and personnel to remote locations. These challenges increase the overall cost of production and can contribute to higher oil prices. Furthermore, the environmental risks associated with extracting oil from challenging locations, such as the potential for oil spills in sensitive ecosystems, can lead to stricter regulations and additional costs. These factors further influence the overall cost of production and, consequently, oil prices. In conclusion, geographical challenges have a profound effect on oil prices. The location of oil reserves, transportation infrastructure, geopolitical tensions, environmental vulnerabilities, and the complexity of extraction sites all contribute to the volatility and fluctuations in oil prices. Understanding these challenges is crucial for policymakers, industry stakeholders, and consumers to anticipate and respond to changes in oil prices effectively. 3.5 Climate change and the future of oil prices. Climate change is a pressing global issue that has far-reaching implications for various sectors, including the energy industry. As the world grapples with the need to reduce greenhouse gas emissions and transition to cleaner and more sustainable energy sources, the future of oil prices is inevitably intertwined with the challenges posed by climate change. The impact of climate change on oil demand. One of the key factors that will shape the future of oil prices is the changing demand for oil as a result of climate change mitigation efforts. As countries strive to meet their commitments under the Paris Agreement and transition to a low-carbon economy, there is a growing emphasis on reducing reliance on fossil fuels, including oil. The transportation sector, which heavily relies on oil, is a significant contributor to greenhouse gas emissions. As governments and consumers increasingly prioritize sustainable transportation options, such as electric vehicles and public transportation, the demand for oil is expected to decline. This shift in consumer behavior, coupled with advancements in renewable energy technologies, could lead to a decrease in oil demand and subsequently impact oil prices. Furthermore, the implementation of carbon pricing mechanisms and environmental regulations aimed at reducing emissions may also influence oil demand. Higher carbon prices and stricter regulations could incentivize industries to adopt cleaner energy alternatives, further reducing the demand for oil. The role of renewable energy in shaping oil prices. The increasing adoption of renewable energy sources, such as solar and wind power, also has implications for oil prices. As renewable energy technologies become more cost-effective and efficient, they are likely to become more competitive with traditional fossil fuels, including oil. The growth of renewable energy could potentially displace oil in various sectors, such as electricity generation and heating. This displacement could lead to a decrease in oil demand and put downward pressure on oil prices. Additionally, the availability of abundant and affordable renewable energy could reduce the need for oil in certain industries, further impacting oil prices. Geopolitical considerations and climate change. Geopolitical factors also play a role in shaping the future of oil prices in the context of climate change. As countries strive to reduce their carbon footprints, there may be shifts in global alliances and geopolitical dynamics. Oil-producing countries heavily reliant on oil revenues may face economic challenges as demand decreases, potentially leading to political instability and conflicts. Moreover, the transition to renewable energy sources may impact the geopolitical landscape by reducing the influence of oil-producing nations. Countries that are currently major oil exporters may need to diversify their economies and reduce their dependence on oil revenues, which could have significant geopolitical implications. Uncertainty and volatility in oil prices. The future of oil prices in the context of climate change is characterized by uncertainty and volatility. The pace and extent of the transition to renewable energy sources, as well as the effectiveness of climate change mitigation efforts, will significantly influence oil prices. While some experts predict a gradual decline in oil prices as the world transitions to cleaner energy sources, others argue that the remaining reserves of oil may become more valuable due to decreasing supply and increasing demand from countries that have been slower to adopt renewable energy technologies. Additionally, the interplay between climate change policies, technological advancements, and geopolitical factors adds further complexity to the future of oil prices. It is challenging to accurately forecast how these factors will evolve and interact, making it difficult to predict the precise trajectory of oil prices in the face of climate change. Conclusion. Climate change is a critical factor that will shape the future of oil prices. The transition to a low-carbon economy, driven by efforts to mitigate climate change, is expected to impact oil demand and subsequently influence oil prices. The increasing adoption of renewable energy sources, geopolitical considerations, and the inherent uncertainty surrounding climate change and energy transitions all contribute to the complex and evolving landscape of oil prices. As the world continues to grapple with the challenges of climate change, the future of oil prices remains uncertain, with potential implications for various sectors and economies worldwide. 3.6 Technological advancements and their impact on oil prices. Technological advancements have always played a significant role in shaping the dynamics of oil prices. From exploration and production to refining and distribution, advancements in technology have revolutionized the oil industry, leading to changes in supply, demand, and ultimately, oil prices. In this section, we will explore the various technological advancements that have had a significant impact on oil prices. 3.6.1 Exploration and production technologies. One of the most crucial aspects of the oil industry is the exploration and production of oil reserves. Technological advancements in this area have greatly influenced oil prices by expanding the availability of oil and reducing production costs. Advancements in seismic imaging and drilling technologies have allowed oil companies to identify and extract oil from previously inaccessible or uneconomical reserves. For example, the development of 3D seismic imaging techniques has improved the accuracy of locating oil reservoirs, enabling companies to target their drilling efforts more effectively. This has led to increased oil discoveries and boosted global oil supply. Furthermore, the introduction of horizontal drilling and hydraulic fracking, has revolutionized the extraction of oil from shale formations. These technologies have unlocked vast reserves of unconventional oil, such as shale oil and tight oil, which were previously considered uneconomical to produce. The increased production of unconventional oil has significantly contributed to global oil supply and has helped stabilize oil prices. 3.6.2 Refining technologies. Refining is a crucial step in the oil industry, where crude oil is processed into various refined products, such as gasoline, diesel, and jet fuel. Technological advancements in refining have had a significant impact on oil prices by improving efficiency, reducing costs, and increasing the quality of refined products. Advanced refining technologies, such as catalytic cracking and hydrocracking, have allowed refineries to convert heavier and lower quality crude oils into higher value products. This has increased the overall yield of valuable refined products from each barrel of crude oil, reducing the demand for higher priced light sweet crude oils. As a result, the availability of refined products has increased, leading to more stable oil prices. Additionally, advancements in refining technologies have also enabled refineries to produce cleaner and more environmentally friendly fuels. The introduction of sulfur removal technologies, such as hydrodesulfurization, has reduced the sulfur content in gasoline and diesel, complying with stricter environmental regulations. This has not only improved air quality but has also influenced oil prices by increasing the demand for low sulfur refined products. 3.6.3 Transportation technologies. Transportation plays a vital role in the oil industry, as oil needs to be transported from production sites to refineries and then to end consumers. Technological advancements in transportation have had a significant impact on oil prices by reducing transportation costs, improving efficiency, and increasing the availability of oil. The development of more efficient pipelines and tanker ships has facilitated the transportation of oil over long distances, reducing transportation costs and increasing the overall supply of oil. Additionally, advancements in pipeline monitoring technologies have improved the safety and reliability of oil transportation, minimizing the risk of spills and disruptions in supply. Furthermore, the introduction of more fuel-efficient vehicles and alternative transportation technologies has influenced oil prices by reducing oil demand. The rise of electric vehicles (EVs) and the improvement of their battery technologies have the potential to significantly reduce oil consumption in the transportation sector. As the adoption of EVs increases, the demand for oil is expected to decline, leading to lower oil prices. 3.6.4 Digitalization and Data Analytics. The digital revolution has also made a significant impact on the oil industry, particularly in the areas of data analytics, automation, and optimization. The use of advanced data analytics and machine learning algorithms has enabled oil companies to optimize their operations, reduce costs, and improve decision-making processes. By analyzing vast amounts of data collected from sensors and monitoring systems, oil companies can identify inefficiencies in their operations and implement corrective measures. This has led to improved production processes, reduced downtime, and increased overall productivity. The optimization of operations has a direct impact on oil prices by reducing production costs and increasing supply. Furthermore, digitalization has also facilitated the integration of various stakeholders in the oil industry, such as suppliers, producers, and consumers. This has improved communication, coordination, and transparency, leading to more efficient supply chains and better market dynamics. The increased efficiency in the oil market has contributed to price stability and reduced price volatility. In conclusion, technological advancements have had a profound impact on oil prices by influencing various aspects of the oil industry, including exploration and production, refining, transportation, and data analytics. These advancements have expanded the availability of oil, reduced production costs, improved efficiency, and increased the quality of refined products. As technology continues to evolve, it will undoubtedly shape the future of the oil industry and have further implications for oil prices. 4. Economic factors and oil prices. 4.1 Global economic growth and oil demand. Global economic growth plays a significant role in shaping the demand for oil and, consequently, influencing oil prices. As economies expand, there is an increased need for energy to fuel industrial production, transportation, and various other sectors. Oil, being the most widely used energy source, becomes a crucial component in meeting this growing demand. The relationship between global economic growth and oil demand is intricate and multifaceted. When economies are thriving, consumer spending increases, leading to higher demand for goods and services. This, in turn, drives up the need for transportation, manufacturing, and construction activities, all of which heavily rely on oil. As a result, the demand for oil rises, exerting upward pressure on oil prices. Conversely, during periods of economic downturn or recession, the demand for oil tends to decline. Reduced consumer spending, lower industrial output, and decreased travel and transportation activities all contribute to a decrease in oil demand. This decline in demand can lead to a surplus of oil in the market, causing prices to fall. The relationship between economic growth and oil demand is not always linear. Various factors can influence the elasticity of oil demand, meaning that the responsiveness of demand to changes in economic growth can vary. These factors include energy efficiency improvements, technological advancements, government policies, and the availability of alternative energy sources. Energy efficiency improvements can dampen the growth in oil demand by reducing the amount of energy required to produce goods and services. As industries become more efficient in their energy usage, the demand for oil may not increase at the same rate as economic growth. This can help mitigate the upward pressure on oil prices. Technological advancements also play a crucial role in shaping oil demand. The development and adoption of alternative energy sources, such as renewable energy and electric vehicles, can reduce the reliance on oil and dampen the growth in oil demand. As these technologies become more cost-effective and accessible, they can provide viable alternatives to oil, particularly in the transportation sector. Government policies can also influence the relationship between economic growth and oil demand. Policies that promote energy conservation, renewable energy, and the use of alternative fuels can help reduce the growth in oil demand. Additionally, policies aimed at reducing carbon emissions and combating climate change may incentivize the transition away from oil, further impacting oil demand. The availability and affordability of alternative energy sources can significantly affect the elasticity of oil demand. If alternative energy sources become more accessible and cost-effective, the demand for oil may be more responsive to changes in economic growth. Conversely, if alternative energy sources are limited or expensive, the demand for oil may remain relatively high, even during periods of slower economic growth. It is important to note that the relationship between economic growth and oil demand can vary across different regions and countries. Developing economies, such as China and India, often experience rapid economic growth, leading to a substantial increase in oil demand. On the other hand, developed economies may exhibit slower growth rates and a more stable or declining demand for oil. In conclusion, global economic growth has a significant impact on oil demand, which, in turn, influences oil prices. During periods of economic expansion, the demand for oil tends to rise, exerting upward pressure on prices. Conversely, during economic downturns, the demand for oil may decline, leading to lower prices. However, the relationship between economic growth and oil demand is complex and can be influenced by various factors, including energy efficiency improvements, technological advancements, government policies, and the availability of alternative energy sources. Understanding these dynamics is crucial for comprehending the fluctuations in oil prices and their implications for the global economy. 4.2 Inflation and oil prices. Inflation is a crucial economic factor that has a significant impact on various industries, including the oil market. The relationship between inflation and oil prices is complex and multifaceted, influenced by a range of factors such as supply and demand dynamics, monetary policies, and global economic conditions. This section will explore the relationship between inflation and oil prices, examining how inflation affects the cost of oil and the implications for consumers, businesses, and the overall economy. The link between inflation and oil prices. Oil prices are influenced by inflation due to the fundamental role that energy plays in the economy. As oil is a vital input in the production of goods and services, any changes in its price can have a cascading effect on the overall cost of living and business operations. When inflation rises, the purchasing power of money decreases, leading to higher prices for goods and services, including oil. One of the primary drivers of inflation is the cost of energy, with oil being a significant component. When oil prices increase, it directly affects the cost of transportation, manufacturing, and other energy-intensive sectors. These increased costs are often passed on to consumers in the form of higher prices for goods and services. As a result, inflationary pressures can be amplified by rising oil prices, leading to a broader increase in the general price level. Supply and demand dynamics. Supply and demand dynamics play a crucial role in the relationship between inflation and oil prices. When demand for oil exceeds supply, prices tend to rise. This can be driven by factors such as economic growth, industrial production, and geopolitical events. Inflationary pressures can arise when increased demand for oil outpaces supply, leading to higher prices for energy and other related products. Conversely, when supply exceeds demand, oil prices tend to decline. This can occur during periods of economic downturns or when there is an oversupply of oil in the market. Lower oil prices can have a deflationary effect on the economy, as they reduce production costs and lower transportation expenses. This can lead to lower prices for goods and services, contributing to a decrease in the overall inflation rate. Monetary policies and central bank actions. Monetary policies and actions taken by central banks also play a significant role in the relationship between inflation and oil prices. Central banks use various tools, such as interest rate adjustments and quantitative easing, to manage inflation and stabilize the economy. These policies can indirectly impact oil prices by influencing the overall level of economic activity and consumer spending. When central banks implement expansionary monetary policies, such as lowering interest rates or injecting liquidity into the financial system, it can stimulate economic growth and increase consumer spending. This can lead to higher demand for oil and subsequently drive up oil prices. Conversely, contractionary monetary policies, such as raising interest rates or reducing money supply, can have the opposite effect, dampening economic activity and potentially lowering oil prices. Global economic conditions. Global economic conditions also have a significant influence on the relationship between inflation and oil prices. Economic growth rates, trade patterns, and currency exchange rates can all impact the demand and supply of oil, thereby affecting its price. When the global economy is experiencing robust growth, there is typically higher demand for oil, which can contribute to inflationary pressures. Conversely, during periods of economic downturns or recessions, demand for oil tends to decrease, leading to lower oil prices. This can have a deflationary effect on the economy, as lower oil prices translate into lower production costs and reduced transportation expenses. However, it is important to note that the relationship between global economic conditions and oil prices is complex and can be influenced by various other factors, such as geopolitical events and market speculation. Implications for consumers, businesses, and the economy. The relationship between inflation and oil prices has significant implications for consumers, businesses, and the overall economy. When oil prices rise due to inflationary pressures, consumers may experience higher prices for gasoline, heating oil, and other energy-related products. This can reduce disposable income and lead to a decrease in consumer spending, potentially impacting economic growth. For businesses, higher oil prices can increase production costs, particularly for industries that heavily rely on energy. This can squeeze profit margins and potentially lead to higher prices for goods and services. Additionally, businesses may face challenges in managing their budgets and planning for future expenses due to the volatility of oil prices influenced by inflation. From an economic perspective, inflationary pressures driven by rising oil prices can impact the overall stability of the economy. High inflation rates can erode the purchasing power of money, leading to reduced consumer confidence and increased uncertainty. Central banks may respond by implementing tighter monetary policies to curb inflation, which can have broader implications for economic growth and financial stability. In conclusion, the relationship between inflation and oil prices is complex and influenced by various factors such as supply and demand dynamics, monetary policies, and global economic conditions. Rising oil prices can contribute to inflationary pressures, impacting consumers, businesses, and the overall economy. Understanding the dynamics between inflation and oil prices is crucial for policymakers, investors, and individuals alike, as it can provide insights into the broader economic landscape and help inform decision-making processes. 4.3 Currency exchange rates and oil prices. Currency exchange rates play a significant role in determining the price of oil in international markets. The relationship between currency exchange rates and oil prices is complex and multifaceted, influenced by various economic factors and market dynamics. In this section, we will explore the interplay between currency exchange rates and oil prices, examining how fluctuations in exchange rates can impact the cost of oil in the global energy market. The basics of currency exchange rates. Before delving into the relationship between currency exchange rates and oil prices, it is essential to understand the basics of how exchange rates work. Currency exchange rates represent the value of one currency in terms of another. They are determined by various factors, including interest rates, inflation rates, economic performance, political stability, and market sentiment. Exchange rates are typically quoted as currency pairs, such as USD/EUR or USD/JPY, indicating the value of one currency relative to another. When the value of a currency appreciates, it means that it has strengthened against another currency, while depreciation signifies a weakening of the currency. The impact of currency exchange rates on oil prices. Fluctuations in currency exchange rates can have both direct and indirect effects on oil prices. Here are some key ways in which currency exchange rates influence the cost of oil. 1. Import and export costs. Oil is traded globally, and most transactions are conducted in US dollars, USD. As a result, changes in exchange rates between the USD and other currencies can directly impact the cost of importing or exporting oil. When the value of the USD strengthens against other currencies, it becomes more expensive for countries using those currencies to purchase oil. Conversely, a weaker USD can lower the cost of oil for importing countries. 2. Production costs. Currency exchange rates can also affect the production costs of oil-producing countries. Many oil-producing nations have their production costs denominated in their local currencies. If the local currency appreciates against the USD, it can increase the production costs for these countries. Conversely, a weaker local currency can lower production costs, making oil extraction more economically viable. 3. Demand and consumption. Exchange rate fluctuations can influence the demand for oil and its derivatives. When a country's currency strengthens, it can lead to higher purchasing power, making oil more affordable. This increased affordability can stimulate demand and consumption, potentially driving up oil prices. Conversely, a weaker currency can reduce purchasing power, leading to lower demand and potentially lower oil prices. 4. Speculation and investor sentiment. Currency exchange rates can also impact oil prices indirectly through their influence on investor sentiment and market speculation. Fluctuations in exchange rates can create uncertainty and volatility in financial markets, leading investors to seek safe haven assets like oil. This increased demand for oil as a hedge against currency risk can drive up prices. Case study: the impact of exchange rates on oil prices. To illustrate the relationship between currency exchange rates and oil prices, let's consider a hypothetical scenario. Suppose the USD strengthens against the euro due to positive economic indicators in the United States. As a result, the exchange rate between the USD and the euro changes from 1 United States dollar equals 85 euro cents to 1 United States dollar equals 80 euro cents. In this scenario, the stronger USD would make oil more expensive for countries using the euro. As a result, the demand for oil in the eurozone may decrease, leading to a potential decline in oil prices. Conversely, oil-producing countries that use the euro as their local currency may benefit from lower production costs due to the weaker euro. However, it is important to note that the relationship between currency exchange rates and oil prices is not always straightforward. Other factors, such as supply and demand dynamics, geopolitical events, and market speculation, can also influence oil prices. Therefore, it is crucial to consider currency exchange rates in conjunction with these other factors when analyzing oil price movements. Conclusion: currency exchange rates play a significant role in shaping the dynamics of oil prices. Fluctuations in exchange rates can directly impact the cost of importing and exporting oil, as well as the production costs for oil-producing countries. Additionally, exchange rate movements can indirectly influence oil prices through their effects on demand, investor sentiment, and market speculation. Understanding the relationship between currency exchange rates and oil prices is crucial for policymakers, investors, and industry participants. By monitoring and analyzing exchange rate movements alongside other economic and market factors, stakeholders can gain valuable insights into the future direction of oil prices and make informed decisions in the global energy market. 4.4 Interest rates and oil prices. Interest rates play a significant role in shaping the dynamics of oil prices. The relationship between interest rates and oil prices is complex and multifaceted, influenced by various economic factors and market conditions. In this section, we will explore the connection between interest rates and oil prices, examining how changes in interest rates can impact the oil market. Interest rates, set by central banks, determine the cost of borrowing money and influence the overall economic environment. When interest rates are low, borrowing becomes cheaper, stimulating economic growth and increasing consumer spending. Conversely, when interest rates are high, borrowing becomes more expensive, leading to reduced economic activity. One of the primary ways in which interest rates affect oil prices is through their impact on global economic growth. As interest rates rise, borrowing costs increase, which can slow down economic activity and dampen demand for oil. When the global economy is experiencing a slowdown, the demand for oil tends to decrease, putting downward pressure on oil prices. Additionally, interest rates can affect the cost of production for oil companies. Higher interest rates increase the cost of borrowing for oil producers, making it more expensive for them to finance exploration, drilling, and production activities. As a result, higher interest rates can lead to reduced investment in the oil sector, potentially impacting future oil supply and, consequently, oil prices. Moreover, interest rates can influence the value of the US dollar, which is the primary currency used for oil trading. When interest rates in the United States rise, the value of the US dollar tends to strengthen. A stronger dollar makes oil more expensive for countries using other currencies, as they need to exchange more of their currency to purchase the same amount of oil. This can lead to a decrease in global oil demand and put downward pressure on oil prices. Conversely, when interest rates in the United States decrease, the value of the US dollar tends to weaken. A weaker dollar makes oil more affordable for countries using other currencies, potentially increasing global oil demand and pushing oil prices higher. The relationship between interest rates and oil prices is not always straightforward and can be influenced by various other factors. For example, geopolitical events, such as conflicts in oil-producing regions or disruptions in oil supply, can overshadow the impact of interest rates on oil prices. Additionally, market sentiment, speculation, and investor behavior can also play a role in shaping oil price movements. It is important to note that the relationship between interest rates and oil prices is not always immediate or direct. Changes in interest rates can take time to filter through the economy and impact oil demand and production. Moreover, the influence of interest rates on oil prices can be influenced by other economic factors, such as inflation, employment levels, and overall market conditions. In recent years, the relationship between interest rates and oil prices has been further complicated by unconventional monetary policies implemented by central banks. Quantitative easing and other measures aimed at stimulating economic growth can have unintended consequences for oil prices. These policies can increase liquidity in financial markets, potentially leading to increased investment in commodities, including oil, and driving up prices. In conclusion, interest rates have a significant impact on the dynamics of oil prices. Changes in interest rates can influence global economic growth, the cost of production for oil companies, the value of the US dollar, and overall market sentiment. However, the relationship between interest rates and oil prices is complex and can be influenced by various other factors. Understanding the interplay between interest rates and oil prices is crucial for investors, policymakers, and industry participants to navigate the volatile and ever-changing oil market. 5. Financial markets and oil prices. 5.1 Commodity markets and oil prices. Commodity markets play a crucial role in determining the price of oil. These markets provide a platform for the buying and selling of various commodities, including oil, which is traded as a commodity. Understanding the dynamics of commodity markets is essential for comprehending the factors that influence oil prices. The basics of commodity markets. Commodity markets are financial markets where raw materials or primary products are traded. These markets facilitate the exchange of commodities between buyers and sellers, allowing them to hedge against price fluctuations and manage their exposure to risk. Commodity markets can be categorized into two types: spot markets and futures markets. Spot markets involve the immediate purchase or sale of a commodity for immediate delivery. In the case of oil, spot markets enable buyers and sellers to trade physical barrels of oil at the current market price. Spot prices are influenced by factors such as supply and demand dynamics, geopolitical events, and market sentiment. On the other hand, futures markets involve the trading of contracts that represent a specific quantity of a commodity to be delivered at a predetermined future date. These contracts allow market participants to speculate on the future price of the commodity. In the case of oil, futures contracts are traded on exchanges such as the New York Mercantile Exchange, NYMEX, and the Intercontinental Exchange, ICE. The role of futures trading in oil prices. Futures trading plays a significant role in determining oil prices. It provides a mechanism for market participants to manage their exposure to price volatility and hedge against potential losses. The interaction between supply and demand in the futures market influences the price discovery process for oil. Market participants in the futures market include producers, consumers, speculators, and hedgers. Producers, such as oil companies, may use futures contracts to lock in prices for future production, ensuring a predictable revenue stream. Consumers, such as airlines or shipping companies, may use futures contracts to secure future oil supplies at a predetermined price, protecting themselves from price fluctuations. Speculators, on the other hand, are individuals or institutions that trade futures contracts with the primary goal of making a profit from price movements. They do not have a direct interest in the physical delivery of the commodity but rather seek to capitalize on price discrepancies. Speculators provide liquidity to the market and contribute to price efficiency. Hedgers are market participants who use futures contracts to offset the risk associated with their physical exposure to the commodity. For example, an oil producer may sell futures contracts to hedge against a potential decline in oil prices, ensuring a minimum price for their production. Similarly, a consumer may buy futures contracts to hedge against a potential increase in oil prices, securing a maximum price for their future purchases. Speculation and oil price volatility. Speculation in commodity markets, including oil, has been a subject of debate and scrutiny. Critics argue that excessive speculation can lead to increased price volatility and distort the fundamentals of supply and demand. They claim that speculators, who do not have a direct interest in the physical commodity, can drive prices away from their fundamental values. However, proponents of speculation argue that it enhances market efficiency by providing liquidity and narrowing bid-ask spreads. They contend that speculators play a vital role in absorbing excess risk from hedgers and contribute to price discovery. Speculation can also provide valuable information about market expectations and future price movements. Regulators have implemented measures to monitor and regulate speculation in commodity markets. These measures aim to prevent market manipulation and ensure fair and transparent trading. For example, position limits may be imposed on speculators to prevent excessive concentration of positions that could potentially disrupt market functioning. Financial instruments and their impact on oil prices. In addition to futures contracts, various financial instruments are used in commodity markets, which can impact oil prices. These instruments include options, exchange-traded funds (ETFs), and over-the-counter OTC derivatives. Options provide the holder with the right, but not the obligation, to buy or sell a commodity at a predetermined price within a specified period. Options can be used by market participants to hedge against price fluctuations or speculate on future price movements. The trading of options can influence the supply and demand dynamics in the market, thereby impacting oil prices. Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges and aim to replicate the performance of a specific commodity or commodity index. ETFs provide investors with exposure to the price movements of oil without directly owning the physical commodity. The trading activity of ETFs can influence the demand for oil-related securities and, consequently, oil prices. Over-the-counter OTC derivatives are privately negotiated contracts between two parties. These contracts can be customized to meet the specific needs of the participants and are not traded on exchanges. OTC derivatives, such as swaps and forwards, allow market participants to manage their exposure to price risk. The trading of OTC derivatives can impact oil prices indirectly by affecting market sentiment and liquidity. In conclusion, commodity markets, particularly futures trading, play a crucial role in determining oil prices. The interaction between supply and demand in these markets, along with the participation of various market participants, influences the price discovery process. Speculation, when regulated appropriately, can enhance market efficiency, while financial instruments can impact oil prices indirectly through their trading activity. Understanding the dynamics of commodity markets is essential for comprehending the complexities of oil price movements. 5.2 Futures and options trading in oil. Futures and options trading play a significant role in the dynamics of oil prices. These financial instruments allow market participants to hedge against price fluctuations, speculate on future price movements, and provide liquidity to the market. In this section, we will explore the basics of futures and options trading in the oil market and examine their impact on oil prices. Futures trading. Futures contracts are standardized agreements to buy or sell a specific quantity of a commodity, such as oil, at a predetermined price and date in the future. In the oil market, the most commonly traded futures contracts are based on benchmark crude oils, such as Brent crude and West Texas Intermediate (WTI) crude. Futures trading in oil provides several benefits to market participants. Firstly, it allows producers and consumers of oil to hedge against price volatility. For example, an oil producer can sell futures contracts to lock in a future selling price, protecting themselves from potential price declines. Similarly, an airline company can buy futures contracts to secure a future buying price, safeguarding against potential price increases. Secondly, futures trading provides liquidity to the market. Speculators, such as hedge funds and institutional investors, actively participate in the oil futures market to profit from price movements. Their involvement enhances market efficiency by increasing trading volume and narrowing bid-ask spreads. Furthermore, futures trading in oil serves as a price discovery mechanism. The interaction of supply and demand forces in the futures market helps determine the equilibrium price of oil. As market participants react to new information and adjust their trading positions, the futures price reflects the collective expectations of market participants regarding future oil prices. Options trading. Options contracts provide the holder with the right, but not the obligation, to buy call option or sell put option a specific quantity of oil at a predetermined price, strike price, within a specified period. Options trading in the oil market offers additional flexibility and risk management tools compared to futures trading. Options trading allows market participants to hedge against price fluctuations while retaining the opportunity to benefit from favorable price movements. For instance, an oil producer can buy put options to protect against price declines while still benefiting from price increases. Similarly, an oil consumer can buy call options to secure a maximum buying price while still benefiting from price decreases. Options trading also enables speculators to take advantage of market expectations and volatility. By buying or selling options, speculators can profit from anticipated price movements or changes in market volatility. However, it is important to note that options trading involves additional risks, such as the expiration of the options contract and the potential loss of the premium paid. Impact on oil prices. Futures and options trading in oil can influence oil prices in several ways. Firstly, the trading activity itself can impact short-term price movements. As market participants buy or sell futures and options contracts, their actions can create buying or selling pressure, leading to price fluctuations. However, these short-term price movements are often temporary and tend to revert to the fundamental supply and demand factors in the long run. Secondly, futures and options trading can affect market sentiment and price expectations. Speculators' positions and trading strategies can influence market participants' perceptions of future oil prices. If speculators collectively take bullish or bearish positions, it can create a self-fulfilling prophecy, leading to price movements in line with their expectations. Moreover, futures and options trading can provide valuable information about market expectations and price trends. The open interest, which represents the total number of outstanding futures or options contracts, can indicate market sentiment and the level of market participation. Changes in open interest can signal shifts in market expectations and potential price movements. However, it is important to note that futures and options trading alone cannot determine the long-term direction of oil prices. Fundamental factors, such as global oil supply and demand dynamics, geopolitical events, and economic conditions, ultimately drive oil prices. Futures and options trading serve as a tool for market participants to manage risk and express their views on future price movements, but they do not dictate the underlying fundamentals. In conclusion, futures and options trading in the oil market provide market participants with essential risk management tools and opportunities for speculation. These financial instruments allow hedging against price volatility, provide liquidity to the market, and contribute to price discovery. While futures and options trading can impact short-term price movements and market sentiment, the long-term direction of oil prices is determined by fundamental factors. 5.3 Speculation and oil price volatility. Speculation plays a significant role in the dynamics of oil prices, often contributing to increased volatility in the market. In this section, we will explore the relationship between speculation and oil price volatility, examining the factors that drive speculative activity and its impact on the overall stability of oil prices. The nature of speculation. Speculation in the oil market refers to the buying and selling of oil contracts with the expectation of making a profit from price fluctuations. Speculators, including hedge funds, investment banks, and individual traders, participate in the market without any intention of taking physical delivery of the oil. Instead, they aim to profit from changes in the price of oil by buying low and selling high or vice versa. Speculation is driven by various factors, including market sentiment, economic indicators, geopolitical events, and supply and demand dynamics. Traders analyze these factors to make informed decisions about the direction of oil prices, taking both short and long positions in the market. Their actions can influence the overall sentiment and direction of oil prices, leading to increased volatility. Impact on oil price volatility. Speculation can contribute to oil price volatility in several ways. First, speculative trading can amplify price movements in the market. When speculators enter the market with large positions, their buying or selling activity can create momentum and drive prices in a particular direction. This can lead to exaggerated price swings, especially when market sentiment is strong. Second, speculation can exacerbate price volatility during periods of uncertainty or market shocks. Speculators often react quickly to new information or events, leading to rapid price adjustments. For example, geopolitical tensions or unexpected supply disruptions can trigger speculative buying or selling, intensifying price movements. Third, speculative activity can create a self-fulfilling prophecy in the market. If enough traders believe that oil prices will rise or fall, their actions can influence market sentiment and drive prices in the anticipated direction. This can lead to a feedback loop, where speculative activity reinforces and amplifies price movements, further increasing volatility. Regulation and oversight. Given the potential impact of speculation on oil price volatility, there have been calls for increased regulation and oversight of the market. Regulators aim to prevent excessive speculation that could disrupt the functioning of the oil market and harm market participants. One approach to regulating speculation is through position limits, which restrict the size of positions that speculators can hold in the market. Position limits aim to prevent excessive concentration of market power and reduce the potential for manipulation. By limiting the size of speculative positions, regulators can help mitigate the impact of speculation on price volatility. Another regulatory tool is increased transparency in the market. Regulators can require speculators to disclose their positions and trading activities, providing market participants with more information to assess the influence of speculation on oil prices. Transparency can help identify potential market abuses and promote a more efficient and stable market. However, it is important to strike a balance between regulation and market efficiency. While excessive speculation can contribute to price volatility, speculation also provides liquidity and price discovery in the market. Speculators play a crucial role in absorbing risk and facilitating trading, which can enhance market efficiency and stability. Criticisms and debates. The role of speculation in oil price volatility has been a subject of debate among economists, policymakers, and market participants. Some argue that speculation is a necessary and beneficial component of the market, as it provides liquidity and improves price efficiency. They contend that attempts to regulate speculation too heavily could hinder market functioning and limit the benefits it brings. On the other hand, critics argue that excessive speculation can distort prices and increase volatility, leading to negative consequences for consumers and businesses. They believe that speculative activity can create artificial price bubbles or contribute to price spikes, which can have detrimental effects on the economy. The debate surrounding speculation and its impact on oil price volatility is complex and multifaceted. While there is no consensus on the optimal level of regulation, it is clear that speculation can influence oil prices and contribute to increased volatility. Striking a balance between market efficiency and stability remains a challenge for regulators and policymakers. Conclusion. Speculation plays a significant role in the dynamics of oil prices, contributing to increased volatility in the market. Speculative activity can amplify price movements, exacerbate volatility during periods of uncertainty, and create a self-fulfilling prophecy in the market. Regulators have implemented measures to mitigate the potential negative effects of speculation, including position limits and increased transparency. However, finding the right balance between regulation and market efficiency remains a challenge. The debate surrounding speculation and its impact on oil price volatility continues, highlighting the complex nature of the relationship between speculation and oil prices. 5.4 Financial instruments and their impact on oil prices. Financial instruments play a significant role in the dynamics of oil prices. These instruments, such as futures contracts, options, and exchange-traded funds (ETFs), provide investors and market participants with various ways to speculate on or hedge against oil price movements. The use of these instruments can have both direct and indirect impacts on oil prices, influencing market sentiment, liquidity, and price volatility. Futures contracts. Futures contracts are one of the most commonly used financial instruments in the oil market. These contracts allow market participants to buy or sell a specified quantity of oil at a predetermined price and date in the future. By entering into futures contracts, both producers and consumers can hedge against price fluctuations and manage their exposure to oil price risk. The trading of futures contracts has a direct impact on oil prices. As market participants buy and sell these contracts, the demand and supply dynamics in the futures market can influence the spot price of oil. For example, if there is a significant increase in the number of long positions buyers in the futures market, it can create upward pressure on oil prices. Conversely, an increase in short positions sellers can exert downward pressure on prices. Options. Options are another financial instrument used in the oil market. Unlike futures contracts, options provide the holder with the right, but not the obligation, to buy or sell oil at a specified price within a certain time frame. Options can be used for speculation or hedging purposes, allowing market participants to take advantage of potential price movements while limiting their downside risk. The trading of options can indirectly impact oil prices. The presence of a liquid options market provides market participants with additional tools to manage their risk exposure. This increased flexibility can attract more participants to the market, enhancing liquidity and potentially reducing price volatility. Additionally, options trading can provide valuable price discovery information, reflecting market expectations and sentiment. Exchange-traded funds (ETFs). Exchange-traded funds (ETFs) are investment funds that trade on stock exchanges, representing a basket of assets, including oil. These funds allow investors to gain exposure to the oil market without directly owning physical barrels of oil. ETFs can be structured as either physically backed or synthetically backed. Physically backed ETFs hold physical barrels of oil, and their demand for oil can directly impact prices. When investors buy shares of a physically backed oil ETF, the fund manager must purchase the corresponding amount of oil, increasing demand and potentially driving up prices. Conversely, when investors sell shares, the fund manager may need to sell oil, potentially putting downward pressure on prices. Synthetically backed ETFs, on the other hand, use derivatives, such as futures contracts, to replicate the performance of the underlying oil price. While these ETFs do not directly impact physical oil. 6. Environmental factors and oil prices. 6.1 Environmental regulations and oil prices. Environmental regulations play a significant role in shaping the dynamics of oil prices. As concerns about climate change and environmental sustainability continue to grow, governments around the world are implementing stricter regulations to reduce greenhouse gas emissions and promote cleaner energy sources. These regulations have a direct impact on the oil industry, influencing both the supply and demand sides of the market. On the supply side, environmental regulations can affect oil prices by imposing restrictions on exploration, production, and refining activities. For instance, regulations may require oil companies to invest in technologies that reduce emissions or to adopt more environmentally friendly practices. These requirements can increase the cost of production and operation, which in turn can lead to higher oil prices. Additionally, regulations may limit access to certain areas for oil exploration, further constraining supply and potentially driving prices up. Furthermore, environmental regulations can also influence the demand for oil. As governments promote cleaner energy alternatives, such as renewable sources and electric vehicles, the demand for oil may decrease. For example, stricter fuel efficiency standards for vehicles can reduce the amount of oil consumed in the transportation sector. Similarly, policies that incentivize the use of renewable energy can lead to a shift away from oil-dependent industries. As the demand for oil decreases, prices may decline due to reduced competition among buyers. The impact of environmental regulations on oil prices can vary depending on the specific policies implemented and the level of enforcement. In some cases, regulations may lead to short-term price increases as companies adjust their operations to comply with new requirements. However, in the long run, these regulations can contribute to a more sustainable and stable energy market. One example of environmental regulations affecting oil prices is the implementation of carbon pricing mechanisms. Carbon pricing involves putting a price on carbon emissions, either through a carbon tax or a cap-and-trade system. By making carbon-intensive activities more expensive, carbon pricing incentivizes companies to reduce their emissions and transition to cleaner energy sources. This can lead to a decrease in oil demand and, consequently, lower oil prices. Another example is the regulation of oil spills and environmental damage caused by oil exploration and production. Governments may impose fines and penalties on companies responsible for environmental accidents, which can increase the cost of doing business in the oil industry. These costs can be passed on to consumers in the form of higher oil prices. It is important to note that the impact of environmental regulations on oil prices is not solely determined by government policies. Public perception and consumer behavior also play a significant role. As environmental awareness grows, consumers may choose to support companies that prioritize sustainability and environmental responsibility. This can create market pressure for oil companies to adopt cleaner practices, which can, in turn, influence oil prices. Furthermore, international agreements and commitments to reduce greenhouse gas emissions, such as the Paris Agreement, can also shape the regulatory landscape and impact oil prices. These agreements can lead to coordinated efforts among countries to transition to cleaner energy sources, which can have long-term implications for the oil market. In conclusion, environmental regulations have a substantial influence on oil prices. They can affect both the supply and demand sides of the market, leading to changes in production costs, exploration activities, and consumer behavior. As governments worldwide continue to prioritize environmental sustainability, it is likely that the impact of these regulations on oil prices will become even more significant in the future. 6.2 Renewable energy and its effect on oil prices. Renewable energy sources, such as solar, wind, hydro, and biofuels, have gained significant attention in recent years as the world seeks to transition to a more sustainable and environmentally friendly energy system. This shift towards renewable energy has the potential to impact various sectors, including the oil industry. In this section, we will explore the effect of renewable energy on oil prices and the dynamics between these two energy sources. The rise of renewable energy. Renewable energy has experienced remarkable growth in recent years, driven by advancements in technology, declining costs, and increasing environmental concerns. Governments, businesses, and individuals are increasingly investing in renewable energy projects and adopting clean energy solutions. This transition is motivated by the need to reduce greenhouse gas emissions, combat climate change, and diversify energy sources. Reduced oil demand. One of the primary effects of the rise of renewable energy is the potential reduction in oil demand. As renewable energy sources become more accessible and cost-effective, they can replace traditional fossil fuels in various sectors, such as electricity generation, transportation, and heating. For example, the adoption of solar and wind power in the electricity sector can reduce the need for oil-fired power plants. In the transportation sector, the emergence of electric vehicles (EVs) poses a significant challenge to the dominance of oil. As EV technology improves and charging infrastructure expands, more consumers are opting for electric cars, reducing their reliance on gasoline and diesel. This shift towards electric mobility has the potential to significantly impact oil demand, especially in countries with high EV adoption rates. Price competition. The increasing availability and affordability of renewable energy sources can create price competition in the energy market. As renewable energy technologies become more efficient and cost-effective, they can offer a viable alternative to oil-based energy sources. This competition can put downward pressure on oil prices, as consumers and businesses have more options to choose from. Additionally, the long-term nature of renewable energy projects, such as solar and wind farms, allows for stable and predictable energy prices. Unlike oil, which is subject to price volatility due to geopolitical factors and market speculation, renewable energy prices are more stable and less susceptible to sudden price fluctuations. This stability can make renewable energy more attractive to consumers and businesses, further impacting oil demand and prices. Geopolitical implications. The rise of renewable energy also has geopolitical implications for oil-producing countries. Historically, many nations have relied heavily on oil exports for economic growth and stability. However, as renewable energy gains traction, the demand for oil may decrease, leading to reduced revenues for oil-producing nations. This can impact their economies, political stability, and influence in global affairs. Furthermore, the shift towards renewable energy can alter the geopolitical dynamics of energy security. Countries that are heavily dependent on oil imports may seek to diversify their energy sources to reduce their vulnerability to oil price shocks and supply disruptions. This diversification can involve investing in renewable energy infrastructure and technologies, further reducing their reliance on oil. Transition challenges. While the rise of renewable energy presents opportunities for reducing oil demand and mitigating environmental impacts, there are also challenges associated with this transition. The intermittent nature of renewable energy sources, such as solar and wind, poses challenges for grid integration and energy storage. Developing efficient and cost. 6.3 Carbon pricing and its influence on oil prices. Carbon pricing is a policy tool that aims to reduce greenhouse gas emissions by placing a financial cost on carbon dioxide, CO2, and other greenhouse gas emissions. It is designed to incentivize industries and individuals to reduce their carbon footprint and transition to cleaner energy sources. Carbon pricing can take the form of a carbon tax or a cap-and-trade system, both of which have the potential to impact oil prices. Carbon tax. A carbon tax is a direct tax on the carbon content of fossil fuels, including oil. The tax is typically levied based on the amount of CO2 emitted when the fuel is burned. The purpose of a carbon tax is to make fossil fuels more expensive and encourage the use of cleaner alternatives. When a carbon tax is implemented, the cost of producing and consuming oil increases, which can lead to higher oil prices. The impact of a carbon tax on oil prices depends on the specific design and implementation of the tax. If the tax is set at a high rate, it can significantly increase the cost of oil production and consumption. This, in turn, can lead to higher prices at the pump for consumers. However, if the tax is set at a low rate or phased in gradually, the impact on oil prices may be less pronounced. Cap and trade. Cap and trade is another form of carbon pricing that sets a limit, or cap, on the total amount of greenhouse gas emissions allowed within a specific jurisdiction. Companies are then allocated a certain number of emissions permits, which they can buy, sell, or trade with other companies. If a company exceeds its allocated emissions limit, it must purchase additional permits to cover the excess emissions. In a cap-and-trade system, the price of emissions permits can indirectly influence oil prices. When the cost of emissions permits increases, companies may seek to reduce their emissions by transitioning to cleaner energy sources or improving energy efficiency. This shift away from oil can decrease the demand for oil, leading to lower oil prices. Conversely, if the cost of emissions permits decreases, companies may find it more cost-effective to continue using oil, potentially leading to higher oil prices. Impact on oil producers. The influence of carbon pricing on oil prices can vary depending on the location and characteristics of oil-producing regions. In regions where oil production is carbon-intensive, such as those with high levels of flaring or energy-intensive extraction methods, the implementation of carbon pricing can significantly increase production costs. This can put pressure on oil producers to either reduce their emissions or pass on the increased costs to consumers through higher oil prices. On the other hand, oil-producing regions with lower carbon intensity may be less affected by carbon pricing. These regions may have a competitive advantage over high-carbon producers, as their production costs remain relatively stable. However, if global demand for oil decreases due to the implementation of carbon pricing, even low-carbon producers may experience a decline in oil prices. Transition to cleaner energy sources. One of the primary goals of carbon pricing is to incentivize the transition to cleaner energy sources, such as renewable energy. As the cost of emitting carbon dioxide increases, the relative cost of renewable energy technologies, such as solar and wind, becomes more competitive. This shift towards cleaner energy sources can reduce the demand for oil, leading to lower oil prices. Additionally, carbon pricing can stimulate investment in research and development of alternative fuels and technologies. This can further accelerate the transition away from oil and contribute to a decrease in oil prices over the long term. Uncertainties and challenges. The influence of carbon pricing on oil prices is subject to various uncertainties and challenges. The effectiveness of carbon pricing policies in reducing greenhouse gas emissions depends on their design, implementation, and enforcement. If carbon pricing policies are not implemented globally or if certain countries or regions opt out, it can create market distortions and uneven impacts on oil prices. Furthermore, the response of oil producers and consumers to carbon pricing can also affect its influence on oil prices. If oil producers are able to reduce their emissions and production costs through technological advancements or operational changes, the impact of carbon pricing on oil prices may be mitigated. Similarly, if consumers are able to shift to alternative energy sources or reduce their oil consumption, it can further dampen the effect of carbon pricing on oil prices. In conclusion, carbon pricing, whether in the form of a carbon tax or a cap-and-trade system, has the potential to influence oil prices. By increasing the cost of oil production and consumption, carbon pricing can incentivize the transition to cleaner energy sources and reduce the demand for oil. However, the impact of carbon pricing on oil prices is contingent on various factors, including the design and implementation of carbon pricing policies, the response of oil producers and consumers, and the global adoption of carbon pricing measures. 6.4 Public perception and consumer behavior. Public perception and consumer behavior play a significant role in shaping the dynamics of oil prices. The way people perceive and respond to changes in oil prices can have a profound impact on demand, supply, and ultimately, the overall price of oil. In this section, we will explore the various factors that influence public perception and consumer behavior in relation to oil prices. 6.4.1 Psychological factors. Psychological factors play a crucial role in shaping public perception and consumer behavior towards oil prices. People's emotions, beliefs, and attitudes towards oil prices can greatly influence their decision-making process. For example, when oil prices are high, consumers may experience a sense of anxiety and fear, leading them to reduce their consumption of oil-related products and services. On the other hand, when oil prices are low, consumers may feel a sense of relief and confidence, leading to increased consumption. 6.4.2 Media influence. The media plays a significant role in shaping public perception and consumer behavior towards oil prices. News outlets, social media platforms, and other forms of media have the power to influence public opinion and create a narrative around oil prices. Media coverage of events such as geopolitical tensions, natural disasters, or economic indicators can create a sense of urgency or panic among consumers, leading to changes in their behavior. For example, a news report highlighting the potential disruption in oil supply due to a political conflict can lead to panic buying and hoarding of oil-related products. 6.4.3 Economic factors. Economic factors also play a crucial role in shaping public perception and consumer behavior towards oil prices. When the economy is thriving, consumers tend to have more disposable income, which can lead to increased demand for oil-related products and services. Conversely, during economic downturns or recessions, consumers may tighten their belts and reduce their consumption of oil-related goods. Additionally, factors such as unemployment rates, inflation, and income inequality can also influence consumer behavior and their perception of oil prices. 6.4.4 Environmental awareness. In recent years, there has been a growing awareness of environmental issues and the impact of fossil fuels on climate change. This increased environmental consciousness has led to changes in public perception and consumer behavior towards oil prices. Consumers are now more inclined to choose alternative energy sources and adopt energy-efficient practices to reduce their carbon footprint. This shift in consumer behavior can have a direct impact on the demand for oil and subsequently influence its price. 6.4.5 Government policies and regulations. Government policies and regulations can significantly influence public perception and consumer behavior towards oil prices. For example, the implementation of carbon pricing mechanisms or subsidies for renewable energy can incentivize consumers to shift away from oil-based products and services. Similarly, regulations on fuel efficiency standards for vehicles can influence consumer choices and impact the demand for oil. Government interventions and policies can shape public perception by signaling the importance of transitioning to sustainable energy sources and reducing dependence on oil. 6.4.6 Social and cultural factors. Social and cultural factors also play a role in shaping public perception and consumer behavior towards oil prices. Cultural norms, values, and societal expectations can influence consumer choices and preferences. For example, in some cultures, owning a large, fuel-inefficient vehicle may be seen as a status symbol, leading to higher demand for oil. Conversely, in cultures that prioritize sustainability and environmental consciousness, consumers may opt for alternative modes of transportation or energy sources, reducing their reliance on oil. 6.4.7 Technological advancements. Technological advancements can also influence public perception and consumer behavior towards oil prices. The development of new technologies, such as electric vehicles or renewable energy sources, can provide consumers with alternatives to traditional oil-based products. As these technologies become more accessible and affordable, consumers may be more inclined to adopt them, reducing their demand for oil and potentially impacting its price. 6.4.8 Market volatility and speculation. Market volatility and speculation can create uncertainty and influence public perception and consumer behavior towards oil prices. Fluctuations in oil prices can lead to speculation and uncertainty among consumers, causing them to adjust their consumption patterns. Additionally, speculation in financial markets can create a perception of oil price volatility, leading consumers to anticipate future price changes and adjust their behavior accordingly. In conclusion, public perception and consumer behavior are crucial factors that influence the dynamics of oil prices. Psychological factors, media influence, economic factors, environmental awareness, government policies, social and cultural factors, technological advancements, and market volatility all play a role in shaping how individuals perceive and respond to changes in oil prices. Understanding these factors is essential for policymakers, industry stakeholders, and consumers alike, as they navigate the complex landscape of oil price dynamics. 7. Transportation and oil prices. 7.1 Oil in the transportation sector. The transportation sector plays a crucial role in the global demand for oil. It is one of the largest consumers of petroleum products, accounting for a significant portion of total oil consumption worldwide. In this section, we will explore the various aspects of oil usage in the transportation sector and its impact on oil prices. Importance of oil in transportation. Oil is the primary source of energy for various modes of transportation, including cars, trucks, ships, airplanes, and trains. The high energy density and portability of oil make it an ideal fuel for these vehicles, allowing them to travel long distances efficiently. As a result, the transportation sector heavily relies on oil to meet its energy needs. The demand for oil in the transportation sector is driven by several factors. Firstly, the growth in population and urbanization has led to an increase in the number of vehicles on the road, particularly in developing countries. As more people can afford cars and other means of transportation, the demand for oil continues to rise. Secondly, economic growth and industrialization also contribute to the demand for oil in the transportation sector. As economies expand, there is a greater need for the movement of goods and services, which requires an efficient transportation system. This, in turn, leads to an increased demand for oil. Impact on oil prices. The demand for oil in the transportation sector has a significant impact on oil prices. When the demand for oil in the transportation sector increases, it puts upward pressure on oil prices. Conversely, a decrease in demand can lead to a decline in oil prices. Several factors influence the demand for oil in the transportation sector. One of the primary factors is the price of oil itself. When oil prices are high, it becomes more expensive for consumers to fuel their vehicles, leading to a decrease in demand. Conversely, when oil prices are low, consumers are more likely to drive more and use more oil, increasing demand. Another factor that affects oil demand in the transportation sector is the efficiency of vehicles. As technology advances, vehicles become more fuel efficient, requiring less oil to travel the same distance. This can help reduce the overall demand for oil in the transportation sector and put downward pressure on oil prices. Government policies and regulations also play a significant role in shaping the demand for oil in the transportation sector. For example, policies that promote the use of alternative fuels or electric vehicles can reduce the demand for oil. Conversely, policies that support the use of oil-based fuels can increase demand. Future trends and challenges. The future of oil in the transportation sector is subject to various trends and challenges. One of the key trends is the increasing focus on sustainability and reducing greenhouse gas emissions. As concerns about climate change grow, there is a growing push to transition to cleaner and more sustainable forms of transportation, such as electric vehicles and renewable fuels. The adoption of electric vehicles, EVs, is expected to have a significant impact on the demand for oil in the transportation sector. As EV technology improves and becomes more affordable, the demand for oil for transportation purposes may decline. This shift towards electric vehicles could potentially lead to a decrease in oil prices, as the demand for oil in the transportation sector decreases. However, there are challenges to the widespread adoption of electric vehicles. These include the limited availability of charging infrastructure, the higher upfront cost of electric vehicles compared to conventional vehicles, and the range limitations of current battery technology. Overcoming these challenges will be crucial for the successful transition to electric vehicles and reducing the dependence on oil in the transportation sector. Another challenge is the development and commercialization of alternative fuels. Biofuels, hydrogen, and natural gas are among the alternatives being explored to reduce the reliance on oil in the transportation sector. However, the widespread adoption of these alternative fuels faces challenges such as infrastructure development, cost competitiveness, and scalability. In conclusion, oil plays a vital role in the transportation sector, being the primary source of energy for various modes of transportation. The demand for oil in this sector is influenced by factors such as population growth, economic development, and government policies. The future of oil in the transportation sector is subject to trends such as the adoption of electric vehicles and the development of alternative fuels. These trends, along with challenges such as infrastructure development and cost competitiveness, will shape the future demand for oil and its impact on oil prices. 7.2 Alternative fuels and their impact on oil prices. As the world becomes increasingly aware of the environmental and economic consequences of relying on fossil fuels, the search for alternative energy sources has gained significant momentum. The development and adoption of alternative fuels have the potential to revolutionize the energy landscape and, in turn, have a profound impact on oil prices. In this section, we will explore the various types of alternative fuels and examine their potential influence on the dynamics of oil prices. The rise of alternative fuels. Alternative fuels are defined as any non-conventional energy sources that can be used as a substitute for traditional fossil fuels such as oil, coal, and natural gas. These fuels are typically derived from renewable resources and have lower carbon emissions compared to their fossil fuel counterparts. The growing interest in alternative fuels is driven by several factors, including concerns over climate change, energy security, and the desire to reduce dependence on finite and geopolitically sensitive oil reserves. Types of alternative fuels. Biofuels. Biofuels are derived from organic matter, such as crops, agricultural residues, and algae. The two most common types of biofuels are ethanol and biodiesel. Ethanol is primarily produced from corn, sugarcane, and other starch or sugar-rich crops, while biodiesel is typically made from vegetable oils or animal fats. Biofuels can be blended with gasoline or diesel and used in conventional vehicles with minimal modifications. Hydrogen. Hydrogen is considered a promising alternative fuel due to its high energy content and zero carbon emissions when used in fuel cells. It can be produced through various methods, including electrolysis of water, steam methane reforming, and biomass gasification. However, the widespread adoption of hydrogen as a fuel source faces challenges related to storage, distribution, and infrastructure development. Natural gas. Natural gas is often touted as a cleaner alternative to oil and coal. It is primarily composed of methane and can be used in a variety of applications, including electricity generation, heating, and transportation. Compressed natural gas, CNG, and liquefied natural gas, LNG, are the two main forms of natural gas used as transportation fuels. The abundance of natural gas reserves and its lower carbon emissions make it an attractive option for reducing oil dependency. Electricity. Electricity is not a fuel in itself but can be used as an alternative to power electric vehicles, EVs. EVs are gaining popularity due to their lower operating costs, reduced emissions, and advancements in battery technology. The electricity used to charge EVs can be generated from a variety of sources, including renewable energy such as solar and wind power. The growth of EVs has the potential to significantly reduce oil demand in the transportation sector. Hydrogen fuel cells. Hydrogen fuel cells combine hydrogen and oxygen to produce electricity, with water being the only byproduct. Fuel cell vehicles, FCVs, offer the advantages of zero emissions and longer driving ranges compared to battery-powered EVs. However, the infrastructure for hydrogen fueling stations is still limited, which hinders the widespread adoption of FCVs. Impact on oil prices. The adoption of alternative fuels has the potential to disrupt the traditional dynamics of oil prices in several ways. Reduced oil demand. As alternative fuels gain traction, particularly in the transportation sector, the demand for oil is likely to decline. This decrease in demand can exert downward pressure on oil prices, especially if the shift towards alternative fuels is significant and sustained. Competition with oil. Alternative fuels, such as biofuels and natural gas, can directly compete with oil in various applications. For instance, biofuels can be blended with gasoline or diesel, reducing the need for pure petroleum-based fuels. Similarly, natural gas can be used as a substitute for oil in power generation and transportation. This competition can limit the pricing power of oil producers and contribute to price volatility. Geopolitical implications. The adoption of alternative fuels can reduce the geopolitical influence of oil-producing nations. As countries diversify their energy sources, they become less reliant on oil imports, reducing the leverage of major oil-producing nations. This shift in power dynamics can have far-reaching geopolitical implications and potentially impact oil prices. Investment and innovation. The development and commercialization of alternative fuels require significant investment in research, infrastructure, and technology. As more resources are allocated to alternative fuel projects, there may be a corresponding reduction in investment in the oil sector. This shift in investment patterns can influence the future supply and demand dynamics of oil, thereby affecting prices. Policy and regulation. Governments around the world are implementing policies and regulations to promote the adoption of alternative fuels and reduce carbon emissions. These policies can include incentives for the production and use of alternative fuels, carbon pricing mechanisms, and stricter emission standards. Such regulations can impact the competitiveness of oil and influence its pricing dynamics. In conclusion, the development and adoption of alternative fuels have the potential to reshape the energy landscape and significantly impact oil prices. The reduced demand for oil, competition with alternative fuels, geopolitical implications, investment patterns, and policy interventions all contribute to the changing dynamics of oil prices. As the world transitions towards a more sustainable and diversified energy mix, understanding the interplay between alternative fuels and oil prices becomes increasingly crucial for policymakers, investors, and consumers alike. 7.3 Electric vehicles and oil demand. The rise of electric vehicles, EVs, has been a significant development in the transportation sector, with potential implications for oil demand and, consequently, oil prices. As the world seeks to transition to cleaner and more sustainable forms of transportation, the adoption of EVs has gained momentum. This section explores the impact of electric vehicles on oil demand and the potential consequences for oil prices. The growth of electric vehicles. In recent years, there has been a remarkable surge in the popularity of electric vehicles. This can be attributed to several factors, including advancements in battery technology, government incentives, and increased environmental awareness. As a result, EV sales have been steadily increasing, and many countries have set ambitious targets to phase out internal combustion engine vehicles in the coming decades. Electric vehicles and oil demand. The widespread adoption of electric vehicles has the potential to significantly reduce oil demand. Traditionally, the transportation sector has been heavily reliant on petroleum-based fuels, such as gasoline and diesel. However, with the shift towards electric vehicles, the demand for these fuels is expected to decline. Electric vehicles offer a cleaner and more energy-efficient alternative to conventional vehicles. By utilizing electricity as their primary source of power, EVs eliminate the need for gasoline or diesel consumption. As a result, the demand for oil in the transportation sector is likely to decrease as more electric vehicles are adopted. Factors influencing the impact on oil demand. While the growth of electric vehicles is expected to reduce oil demand, several factors can influence the extent of this impact. These factors include the rate of EV adoption, government policies, technological advancements, and consumer preferences. The rate of EV adoption plays a crucial role in determining the impact on oil demand. If electric vehicles gain widespread acceptance and become the dominant mode of transportation, the reduction in oil demand could be significant. However, if the adoption rate remains relatively slow, the impact on oil demand may be more gradual. Government policies and incentives also play a vital role in shaping the transition to electric vehicles. Many countries have implemented measures to promote the adoption of EVs, such as subsidies, tax incentives, and the development of charging infrastructure. These policies can accelerate the shift towards electric vehicles and, consequently, impact oil demand. Technological advancements in battery technology and charging infrastructure are essential for the widespread adoption of electric vehicles. Improvements in battery efficiency, range, and charging speed can enhance the appeal of EVs and further reduce reliance on oil. Additionally, the availability and accessibility of charging stations can alleviate concerns about range anxiety and encourage more consumers to switch to electric vehicles. Consumer preferences and attitudes towards electric vehicles also play a significant role in shaping oil demand. Factors such as vehicle affordability, driving range, charging infrastructure, and perceptions of EV performance can influence consumer decisions. As consumer awareness and acceptance of electric vehicles increase, the demand for oil in the transportation sector is likely to decline further. Implications for oil prices. The impact of electric vehicles on oil prices is a topic of much debate and speculation. The reduction in oil demand resulting from the widespread adoption of EVs could potentially lead to lower oil prices. As the demand for oil decreases, the market could become oversupplied, putting downward pressure on prices. However, the relationship between electric vehicles and oil prices is complex and influenced by various factors. While the growth of electric vehicles may reduce oil demand, other factors such as economic growth, geopolitical events, and OPEC's production decisions can also impact oil prices. Therefore, it is challenging to predict the precise effect of electric vehicles on oil prices. Furthermore, the transition to electric vehicles is not expected to happen overnight. It will likely take several decades for electric vehicles to become the dominant mode of transportation globally. During this transition period, oil prices may experience fluctuations due to a combination of factors, including the growth of electric vehicles, changes in oil supply and demand dynamics, and geopolitical developments. Conclusion. The rise of electric vehicles has the potential to reshape the transportation sector and significantly impact oil demand. As more countries and consumers embrace electric vehicles, the demand for oil in the transportation sector is expected to decline. However, the precise impact on oil prices is uncertain and influenced by various factors. While the growth of electric vehicles may put downward pressure on oil prices in the long term, other factors can also influence oil price dynamics. As the world continues to transition towards a more sustainable future, monitoring the interplay between electric vehicles and oil demand will be crucial for understanding the dynamics of oil prices. 7.4 Infrastructure and oil price volatility. Infrastructure plays a crucial role in the oil industry and has a significant impact on oil price volatility. The availability, efficiency, and reliability of infrastructure can greatly influence the supply and demand dynamics of oil, leading to fluctuations in prices. In this section, we will explore the relationship between infrastructure and oil price volatility, examining various factors that contribute to this volatility. Importance of infrastructure in the oil industry. Infrastructure refers to the physical facilities and systems necessary for the extraction, production, transportation, and storage of oil. This includes pipelines, refineries, storage tanks, terminals, and transportation networks such as ships, trucks, and railways. The quality and capacity of these infrastructure components are vital for the smooth functioning of the oil industry. Efficient infrastructure ensures the timely and cost-effective movement of oil from production sites to refineries and ultimately to end consumers. It helps in maintaining a stable supply chain, reducing bottlenecks, and minimizing disruptions. When infrastructure is well developed and adequately maintained, it can enhance market stability and mitigate price volatility. Bottlenecks and supply disruptions. One of the key factors contributing to oil price volatility is the occurrence of bottlenecks and supply disruptions in the infrastructure network. Bottlenecks can arise due to inadequate pipeline capacity, limited storage facilities, or transportation constraints. These bottlenecks restrict the flow of oil, leading to supply shortages and price spikes. For example, if there is a sudden increase in oil production in a particular region without sufficient pipeline capacity to transport the excess oil to refineries or storage facilities, it can result in a bottleneck. This can lead to a buildup of inventory at production sites, causing prices to decline due to oversupply. Conversely, if there is a disruption in the transportation infrastructure, such as a pipeline leak or a port closure, it can disrupt the supply chain and cause prices to surge. Storage capacity and inventory levels. The availability of adequate storage capacity is crucial for managing oil price volatility. Storage facilities allow for the accumulation of excess supply during periods of low demand and act as a buffer during supply disruptions. When storage capacity is limited, it can exacerbate price volatility. During periods of oversupply, when production exceeds demand, oil producers may be forced to sell their excess inventory at discounted prices, leading to a decline in oil prices. Conversely, during periods of supply shortages, when demand exceeds production, the lack of sufficient storage capacity can result in price spikes as buyers compete for limited supply. Transportation costs and price pass-through. Transportation costs also contribute to oil price volatility. The cost of transporting oil from production sites to refineries and from refineries to end consumers can vary depending on the distance, mode of transportation, and infrastructure efficiency. These transportation costs are ultimately passed on to consumers in the form of higher fuel prices. When transportation costs increase, either due to higher fuel prices or infrastructure constraints, it can lead to higher oil prices. For example, if there is a disruption in the shipping industry, such as a shortage of tanker vessels or increased maritime security costs, it can result in higher transportation costs and subsequently higher oil prices. Infrastructure investment and price stability. Investment in infrastructure development and maintenance is crucial for ensuring price stability in the oil market. Adequate investment can help address bottlenecks, increase storage capacity, improve transportation efficiency, and reduce supply disruptions. By enhancing the resilience and reliability of the infrastructure network, price volatility can be minimized. Governments, oil companies, and industry stakeholders play a vital role in infrastructure investment. Governments can incentivize infrastructure development through policies and regulations that promote investment in the oil sector. Oil companies can collaborate with infrastructure providers to ensure the availability of efficient and reliable infrastructure. Industry stakeholders can work together to identify and address infrastructure gaps and invest in projects that enhance the overall infrastructure network. Conclusion. Infrastructure is a critical component of the oil industry and has a significant impact on oil price volatility. Bottlenecks, supply disruptions, storage capacity, transportation costs, and infrastructure investment all contribute to the volatility of oil prices. By addressing these factors and investing in the development and maintenance of efficient infrastructure, the oil industry can mitigate price volatility and ensure a more stable market. 8. Government policies and oil prices. 8.1 Energy subsidies and their effect on oil prices. Energy subsidies play a significant role in shaping the dynamics of oil prices. Subsidies are financial incentives provided by governments to reduce the cost of energy for consumers or producers. These subsidies can take various forms, such as direct cash transfers, tax exemptions, or price controls. While the intention behind energy subsidies is often to promote economic growth, social welfare, or energy security, their impact on oil prices can be complex and multifaceted. One of the primary effects of energy subsidies on oil prices is the distortion of market forces. By artificially lowering the cost of energy, subsidies can create an imbalance between supply and demand. When consumers pay less for oil and other energy sources, they tend to consume more, leading to increased demand. This surge in demand can put pressure on oil prices, driving them higher than they would be in a subsidy-free market. Moreover, energy subsidies can also incentivize overconsumption and waste. When energy prices are artificially low, consumers have less incentive to conserve energy or seek alternative, more efficient sources. This can lead to higher overall energy consumption, which in turn increases the demand for oil. As a result, energy subsidies can contribute to the upward pressure on oil prices. Another consequence of energy subsidies is the distortion of investment patterns in the energy sector. Subsidies can create an artificial preference for certain energy sources, such as fossil fuels, over others, like renewable energy. When governments provide financial support to oil producers or consumers, it can discourage investment in alternative energy technologies and hinder the transition to a more sustainable energy system. This reliance on fossil fuels perpetuates the demand for oil and can contribute to higher oil prices in the long run. Furthermore, energy subsidies can have a significant impact on government budgets and fiscal stability. Subsidies often require substantial financial resources, which can strain government budgets and lead to fiscal deficits. As a result, governments may resort to borrowing or printing money, which can lead to inflationary pressures. Inflation, in turn, can drive up the cost of production and transportation, ultimately affecting oil prices. It is worth noting that the effect of energy subsidies on oil prices can vary depending on the specific context and the magnitude of the subsidies. In some cases, subsidies may be targeted towards specific sectors or regions, which can create localized distortions in oil prices. For example, subsidies provided to the transportation sector can increase the demand for oil and lead to higher prices in that particular market segment. Additionally, the removal or reduction of energy subsidies can have a significant impact on oil prices. When subsidies are phased out, the true cost of energy is revealed, leading to a decrease in demand and a subsequent decline in oil prices. However, the removal of subsidies can also result in short-term price shocks and economic disruptions, particularly in countries heavily reliant on subsidized energy. In recent years, there has been a growing recognition of the negative consequences of energy subsidies on both the environment and the economy. Many countries have started to reform their subsidy programs to align with sustainable development goals and reduce their dependence on fossil fuels. These reforms aim to promote energy efficiency, encourage the use of renewable energy sources, and mitigate the impact of subsidies on oil prices. In conclusion, energy subsidies have a significant effect on oil prices. By distorting market forces, incentivizing overconsumption, and influencing investment patterns, subsidies can contribute to higher oil prices. Additionally, subsidies can strain government budgets and lead to inflationary pressures, further impacting oil prices. However, the removal or reduction of subsidies can also result in price shocks and economic disruptions. As countries strive to transition to a more sustainable energy system, reforming energy subsidy programs becomes crucial to achieving a stable and balanced oil market. 8.2 Taxation and oil prices. Taxation plays a significant role in shaping the dynamics of oil prices. Governments around the world impose various taxes on the production, consumption, and trade of oil, which can have both direct and indirect effects on the price of this crucial commodity. In this section, we will explore the relationship between taxation and oil prices, examining how different tax policies can impact the cost of oil for consumers and the profitability of oil producers. Taxation on oil production. One of the primary ways governments generate revenue from the oil industry is through taxation on oil production. These taxes are typically levied on oil companies based on the volume of oil they extract or the value of the oil produced. The level of taxation can vary significantly across different countries and regions, depending on their fiscal policies and economic objectives. Higher taxes on oil production can increase the cost of extracting oil, which, in turn, can influence the price of oil in the global market. When oil companies face higher production taxes, they may pass on these additional costs to consumers, leading to higher oil prices. Conversely, lower production taxes can reduce the cost of extraction, potentially resulting in lower oil prices. Taxation on oil consumption. Governments also impose taxes on the consumption of oil products, such as gasoline and diesel fuel. These taxes, commonly known as fuel taxes or excise taxes, are typically included in the retail price of petroleum products. The purpose of these taxes is twofold: to generate revenue for the government and to discourage excessive consumption of fossil fuels. Fuel taxes can have a direct impact on the price of oil for consumers. Higher fuel taxes increase the retail price of petroleum products, making them more expensive for consumers. This can lead to reduced demand for oil products, as consumers may seek alternative modes of transportation or opt for more fuel-efficient vehicles. On the other hand, lower fuel taxes can make oil products more affordable, potentially stimulating higher consumption and increasing oil prices. Taxation and price volatility. Taxation policies can also influence the volatility of oil prices. Fluctuations in tax rates can introduce uncertainty into the market, affecting the behavior of both producers and consumers. Sudden changes in tax policies, such as increases or decreases in production or consumption taxes, can create price shocks and disrupt the stability of oil markets. For example, if a government decides to increase taxes on oil production, oil companies may reduce their production levels in response to the higher costs. This reduction in supply can lead to a temporary shortage of oil in the market, driving up prices. Conversely, a decrease in production taxes can incentivize higher production levels, potentially leading to an oversupply of oil and a subsequent decline in prices. Similarly, changes in consumption taxes can impact consumer behavior and oil price volatility. Higher fuel taxes can discourage consumption, leading to lower demand and potentially lower prices. Conversely, lower fuel taxes can stimulate consumption, increasing demand and potentially driving up prices. Taxation and government revenue. Taxation on the oil industry is a crucial source of revenue for many governments. The revenue generated from oil taxes can be used to fund public infrastructure projects, social welfare programs, and other government initiatives. However, the reliance on oil taxes can create challenges for governments, particularly in times of oil price volatility. When oil prices are high, governments may benefit from increased tax revenue as the value of oil production and consumption rises. However, during periods of low oil prices, governments may experience a decline in tax revenue, which can strain their budgets and lead to fiscal deficits. This volatility in government revenue highlights the importance of diversifying the economy and reducing dependence on oil taxes to ensure fiscal stability. Conclusion. Taxation is a crucial factor in determining the price of oil. Taxes on oil production and consumption can directly impact the cost of oil for consumers and the profitability of oil producers. Changes in tax policies can introduce volatility into oil markets, influencing supply and demand dynamics and ultimately affecting oil prices. Additionally, taxation on the oil industry serves as a significant source of government revenue, but reliance on oil taxes can create fiscal challenges during periods of price volatility. Understanding the relationship between taxation and oil prices is essential for policymakers, industry stakeholders, and consumers alike, as it helps shed light on the complex dynamics of the oil market. 8.3 Energy security and oil price stability. Energy security is a critical concern for countries around the world. It refers to the availability and accessibility of energy resources, particularly oil, to meet the energy needs of a nation. Oil price stability plays a crucial role in ensuring energy security, as fluctuations in oil prices can have significant economic, social, and political implications. In this section, we will explore the relationship between energy security and oil price stability, and the measures taken by governments to mitigate the risks associated with oil price volatility. The importance of energy security. Energy security is vital for the smooth functioning of economies and the well-being of societies. Oil is the most widely used energy source globally, accounting for a significant portion of the world's energy consumption. It is a crucial input for transportation, industrial production, and power generation. Therefore, any disruption in the availability or affordability of oil can have severe consequences for countries heavily reliant on it. Factors influencing energy security. Several factors influence energy security, including domestic oil production, import dependence, geopolitical stability, and the diversification of energy sources. Countries with abundant domestic oil reserves and a robust production capacity are generally more energy secure than those heavily dependent on oil imports. However, even oil-producing nations can face energy security challenges if their production capacity is insufficient to meet domestic demand. Import-dependent countries are particularly vulnerable to oil price fluctuations and supply disruptions. They rely on international oil markets to meet their energy needs, making them susceptible to geopolitical tensions, conflicts, and trade disruptions. Diversification of energy sources, such as promoting renewable energy and alternative fuels, can enhance energy security by reducing dependence on oil. The role of oil price stability. Oil price stability is crucial for energy security as it ensures a predictable and affordable supply of oil. Stable oil prices provide certainty to consumers, businesses, and governments, enabling them to plan and allocate resources effectively. Conversely, volatile oil prices can lead to economic instability, inflationary pressures, and budgetary challenges for governments. When oil prices are high and volatile, it can strain the budgets of oil importing countries, especially those with limited financial resources. The increased cost of oil imports can lead to higher inflation, reduced consumer purchasing power, and a decline in economic growth. Moreover, volatile oil prices can create uncertainty for businesses, making it difficult for them to make long-term investment decisions. Measures to enhance energy security and oil price stability. Governments employ various strategies to enhance energy security and mitigate the risks associated with oil price volatility. These measures include diversification of energy sources. Governments promote the development and use of alternative energy sources, such as renewable energy, nuclear power, and natural gas, to reduce dependence on oil. Diversification helps to enhance energy security by providing a more balanced and resilient energy mix. Energy efficiency. Governments implement energy efficiency measures to reduce overall energy consumption and dependence on oil. Improving energy efficiency in transportation, buildings, and industrial processes can significantly reduce oil demand and enhance energy security. Strategic reserves. Many countries maintain strategic petroleum reserves (SPRs) to ensure a buffer against supply disruptions and price spikes. These reserves act as a safety net during emergencies and provide stability to oil markets. International cooperation. Countries collaborate through organizations like the International Energy Agency (IEA) to coordinate emergency response measures, share information, and address energy security challenges collectively. International cooperation helps to stabilize oil markets and ensure a reliable supply of oil. Diplomatic engagement. Governments engage in diplomatic efforts to promote stability in oil-producing regions and resolve geopolitical conflicts that can disrupt oil supplies. Diplomatic initiatives aim to reduce tensions and ensure the uninterrupted flow of oil to global markets. Market regulation. Governments regulate oil markets to prevent excessive speculation and manipulation that can lead to price volatility. Regulatory measures include position limits, transparency requirements, and oversight of financial instruments linked to oil prices. Investment in infrastructure. Governments invest in energy infrastructure, such as pipelines, storage facilities, and refining capacity, to enhance the resilience and efficiency of the oil supply chain. Well-developed infrastructure ensures a smooth flow of oil and reduces the risk of disruptions. By implementing these measures, governments strive to enhance energy security and promote oil price stability, thereby safeguarding their economies and ensuring the well-being of their citizens. In conclusion, energy security and oil price stability are closely intertwined. Stable oil prices are essential for ensuring a predictable and affordable supply of oil, which is crucial for the smooth functioning of economies. Governments employ various strategies, including diversification of energy sources, energy efficiency measures, strategic reserves, international cooperation, diplomatic engagement, market regulation, and investment in infrastructure, to enhance energy security and mitigate the risks associated with oil price volatility. These measures aim to provide stability, reduce dependence on oil, and ensure a reliable and sustainable energy future. 8.4 Strategic reserves and their influence on oil prices. Strategic reserves play a crucial role in the stability of oil prices and the overall energy security of a country. These reserves are stockpiles of crude oil and petroleum products that are strategically stored by governments and international organizations to ensure a steady supply of oil during times of disruption or emergencies. The purpose of strategic reserves is to mitigate the impact of supply disruptions, stabilize prices, and maintain a reliable energy supply for both domestic and international markets. The importance of strategic reserves. Strategic reserves act as a buffer against unexpected events that can disrupt the normal flow of oil supply. These events can include natural disasters, geopolitical conflicts, terrorist attacks, or sudden disruptions in oil production or transportation infrastructure. By having strategic reserves in place, countries can minimize the impact of such events on their economies and ensure the availability of oil for essential sectors like transportation, industry, and agriculture. One of the primary objectives of strategic reserves is to prevent severe price spikes and supply shortages during times of crisis. By releasing oil from these reserves into the market, governments can stabilize prices and meet the immediate demand for oil. This helps to maintain economic stability and prevent panic buying or hoarding by consumers and businesses. National and international strategic reserves. Strategic reserves can be maintained at both national and international levels. National strategic reserves are stockpiles held by individual countries to ensure their energy security. These reserves are typically managed by government agencies or state-owned entities responsible for maintaining and operating the storage facilities. International strategic reserves, on the other hand, are collective reserves held by groups of countries or international organizations. The most prominent example of an international strategic reserve is the Strategic Petroleum Reserve (SPR) in the United States. The SPR is the largest emergency oil stockpile in the world and is managed by the U.S. Department of Energy. It was established in the 1970s in response to the oil shocks of that era and is designed to provide a cushion against severe disruptions in oil supply. Influence on oil prices. The existence of strategic reserves can have a significant influence on oil prices. The mere knowledge that a country or group of countries has substantial reserves can act as a deterrent to potential supply disruptions. This knowledge can help stabilize prices by reducing market speculation and uncertainty. During times of crisis or supply disruptions, the release of oil from strategic reserves can have an immediate impact on prices. By injecting additional supply into the market, the release of strategic reserves can help alleviate shortages and reduce price volatility. This can be particularly effective when the disruption is temporary, and the market expects a return to normalcy in the near future. However, the impact of strategic reserves on oil prices is not without limitations. The size of the reserves and the duration of the disruption play a crucial role in determining the extent of their influence. If the disruption is prolonged or the reserves are insufficient to meet the demand, the effect on prices may be limited. Challenges and considerations. Maintaining strategic reserves comes with its own set of challenges and considerations. One of the primary challenges is the cost associated with acquiring, storing, and maintaining these reserves. Building and operating storage facilities, as well as purchasing and replenishing the oil stocks, require significant financial resources. Governments must carefully balance the costs of maintaining strategic reserves with other budgetary priorities. Another consideration is the optimal size of strategic reserves. Determining the appropriate level of reserves involves assessing factors such as the country's energy consumption, import dependency, and potential supply disruptions. Striking the right balance is crucial to ensure that the reserves are sufficient to address emergencies without excessive costs or inefficiencies. Additionally, the decision to release oil from strategic reserves is a complex one. Governments must carefully evaluate the severity of the disruption, the potential impact on prices in the economy, and the long-term consequences of depleting the reserves. Premature or excessive releases can undermine the effectiveness of strategic reserves and lead to unintended consequences. Conclusion. Strategic reserves are an essential tool for ensuring energy security and stabilizing oil prices. By providing a cushion against supply disruptions, these reserves help mitigate the impact of crises and maintain a reliable energy supply. The existence of strategic reserves can act as a deterrent to potential disruptions and reduce market speculation. However, their influence on oil prices is contingent upon various factors, including the size of the reserves and the duration of the disruption. Governments must carefully manage and maintain strategic reserves to strike the right balance between cost, effectiveness, and long-term energy security. 9. Market speculation and oil prices. 9.1 Speculative trading and oil price fluctuations. Speculative trading plays a significant role in the dynamics of oil prices. It involves the buying and selling of oil contracts with the expectation of making a profit from price movements. Speculators, including hedge funds, investment banks, and individual traders, participate in the oil market to take advantage of price fluctuations. While speculation can provide liquidity and efficiency to the market, it can also contribute to increased volatility and price distortions. Speculative trading in the oil market is driven by various factors. One of the primary motivations for speculators is the potential for profit. They analyze market trends, supply and demand dynamics, geopolitical events, and economic indicators to make informed trading decisions. Speculators often use technical analysis and fundamental analysis to identify patterns and trends that can help them predict future price movements. The impact of speculative trading on oil prices can be both positive and negative. On one hand, speculators can provide liquidity to the market, facilitating efficient price discovery. They can also help stabilize prices by taking positions that counterbalance the actions of other market participants. For example, if producers are selling large quantities of oil contracts, speculators can buy these contracts, preventing a sharp decline in prices. On the other hand, speculative trading can also contribute to increased price volatility. Speculators may amplify price movements by taking large positions or engaging in high-frequency trading strategies. Their actions can create short-term price distortions that do not necessarily reflect the underlying supply and demand fundamentals of the oil market. This volatility can have significant implications for market participants, including producers, consumers, and governments. The influence of speculative trading on oil prices can be seen during periods of market uncertainty or geopolitical tensions. Speculators may anticipate potential disruptions in supply or changes in demand and adjust their positions accordingly. This can lead to exaggerated price movements that may not align with the actual fundamentals of the market. For example, if speculators anticipate a conflict in a major oil-producing region, they may buy oil contracts, driving up prices even if there is no immediate impact on supply. Regulation of speculative trading in oil markets varies across different jurisdictions. Some countries have implemented measures to limit excessive speculation and promote market stability. These measures include position limits, which restrict the size of positions that speculators can hold, and margin requirements, which determine the amount of capital that traders must have to enter into a position. Regulators also monitor trading activities to detect and prevent market manipulation or abusive practices. Critics argue that excessive speculation can lead to market distortions and price bubbles. They contend that speculators who have no intention of taking physical delivery of oil contracts can artificially inflate prices, creating a disconnect between the futures market and the physical market. This can have adverse effects on consumers and businesses that rely on stable and predictable oil prices. However, proponents of speculative trading argue that it provides valuable market information and enhances liquidity. They contend that speculators play a crucial role in absorbing risk and providing hedging opportunities for commercial participants. Speculative trading can also contribute to price efficiency by incorporating market expectations and reflecting new information in real time. In conclusion, speculative trading significantly influences the fluctuations of oil prices. While it can provide liquidity and efficiency to the market, it can also contribute to increased volatility and price distortions. Speculators analyze various factors to make informed trading decisions, and their actions can have both positive and negative impacts on oil prices. Regulation of speculative trading varies across jurisdictions, with some countries implementing measures to limit excessive speculation. Understanding the role of speculation in oil markets is crucial for market participants and policymakers to navigate the complexities of oil price dynamics. 9.2 Hedging strategies and their impact on oil prices. Hedging is a risk management strategy used by market participants to protect themselves against potential price fluctuations in the future. In the context of oil prices, hedging strategies play a significant role in mitigating risks for both producers and consumers. This section will explore the various hedging strategies employed in the oil market and their impact on oil prices. The need for hedging in the oil market. The oil market is highly volatile and subject to various factors that can cause significant price fluctuations. Producers, such as oil companies and oil-producing nations, face the risk of a decline in oil prices, which can negatively impact their revenues and profitability. On the other hand, consumers, including industries and transportation sectors, are exposed to the risk of a sudden increase in oil prices, which can lead to higher production costs and reduced profitability. Hedging allows market participants to protect themselves against these price risks by entering into financial contracts known as derivatives. These derivatives, such as futures contracts and options, enable participants to lock in a specific price for future oil deliveries, thereby reducing their exposure to price volatility. Types of hedging strategies. Futures contracts. One of the most common hedging strategies in the oil market is the use of futures contracts. A futures contract is an agreement to buy or sell a specified quantity of oil at a predetermined price and date in the future. Producers can use futures contracts to lock in a favorable price for their future oil production, ensuring a stable revenue stream. Similarly, consumers can use futures contracts to secure a fixed price for their future oil purchases, protecting themselves against potential price increases. Options contracts. Options contracts provide the holder with the right, but not the obligation, to buy or sell oil at a predetermined price within a specified period. Hedgers can use options contracts to protect themselves against adverse price movements while still allowing them to benefit from favorable price changes. For example, a producer can purchase a put option to sell oil at a specific price, providing downside protection in case of a price decline. Conversely, a consumer can buy a call option to purchase oil at a predetermined price, safeguarding against potential price increases. Swaps. Swaps are financial agreements in which two parties exchange cash flows based on a predetermined formula. In the oil market, swaps are commonly used to hedge against price differentials between different grades of oil or different delivery locations. For instance, a producer may enter into a swap agreement to exchange the price difference between Brent crude and West Texas Intermediate (WTI) crude, ensuring a fixed price for their oil regardless of the price spread between the two grades. Impact of hedging on oil prices. Hedging strategies can have both direct and indirect impacts on oil prices. Here are some key ways in which hedging affects the dynamics of oil prices. Price stability. Hedging helps to stabilize oil prices by reducing the impact of sudden supply or demand shocks. When market participants hedge their positions, they are less likely to engage in panic selling or buying, which can exacerbate price volatility. By providing a mechanism to manage price risks, hedging contributes to a more stable and predictable oil market. Increased market efficiency. Hedging activities in the oil market enhance market efficiency by improving price discovery and liquidity. As participants hedge their positions, they provide liquidity to the market, facilitating smoother transactions and reducing bid-ask spreads. This increased liquidity and transparency contribute to more accurate price signals and efficient allocation of resources. Incentives for investment. Hedging provides producers with the confidence to invest in long-term projects, such as exploration and production, by reducing the uncertainty associated with oil price fluctuations. When producers can secure a favorable price through hedging, they are more likely to undertake capital-intensive projects, leading to increased oil supply in the future. Risk transfer. Hedging allows market participants to transfer price risks to speculators or other market participants willing to take on those risks. This risk transfer function of hedging helps to distribute and manage risks more efficiently in the market. Speculators, who are willing to bear the price risks, provide liquidity and depth to the market, enhancing its overall functioning. Impact on speculation. Hedging can have an indirect impact on speculation in the oil market. By providing a mechanism for market participants to manage their price risks, hedging reduces the need for speculative trading solely for risk management purposes. This, in turn, can help to mitigate excessive speculation and reduce the potential for speculative bubbles or price distortions. In conclusion, hedging strategies play a crucial role in managing price risks and ensuring stability in the oil market. By allowing market participants to protect themselves against price fluctuations, hedging contributes to price stability, increased market efficiency, and incentives for investment. Additionally, hedging helps to transfer price risks and can indirectly impact speculation in the oil market. Overall, hedging strategies have a significant influence on the dynamics of oil prices and contribute to a more robust and resilient oil market. 9.3 Market sentiment and oil price volatility. Market sentiment plays a crucial role in determining the volatility of oil prices. It refers to the overall attitude or feeling of market participants towards the oil market. This sentiment can be influenced by a variety of factors, including economic indicators, geopolitical events, and investor behavior. Understanding market sentiment is essential for predicting and analyzing oil price movements. One of the key drivers of market sentiment is investor perception of supply and demand dynamics. When investors believe that oil supply will exceed demand, they may adopt a bearish sentiment, expecting prices to decline. Conversely, if investors anticipate a supply shortage or increased demand, they may adopt a bullish sentiment, expecting prices to rise. These perceptions can be influenced by factors such as production levels, inventories, and economic growth forecasts. Economic indicators also play a significant role in shaping market sentiment. Factors such as GDP growth, employment rates, and consumer spending can provide insights into the health of the global economy and its impact on oil demand. Positive economic indicators often lead to a bullish sentiment, as investors expect increased oil consumption. Conversely, negative economic indicators can create a bearish sentiment, as investors anticipate reduced oil demand. Geopolitical events can have a profound impact on market sentiment and oil price volatility. Political instability, conflicts, and sanctions in major oil-producing regions can disrupt supply and create uncertainty in the market. These events can lead to heightened volatility as investors react to changing geopolitical dynamics. For example, tensions in the Middle East, a major oil-producing region, can cause oil prices to spike due to concerns over potential supply disruptions. Investor behavior and psychological factors also contribute to market sentiment and oil price volatility. The fear of missing out (FOMO) or the fear of losing out (FOLO) can drive investors to buy or sell oil contracts, respectively, based on the actions of others in the market. This herd mentality can amplify price movements and increase volatility. Additionally, emotions such as greed and fear can influence investor decisions, leading to irrational buying or selling behavior. The media and financial analysts also play a role in shaping market sentiment. News reports, expert opinions, and market analysis can influence investor perceptions and subsequently impact oil prices. Positive or negative coverage of oil-related events can create a bias in market sentiment, leading to price fluctuations. It is important for investors to critically evaluate the information they receive and consider multiple perspectives to form an informed opinion. Market sentiment can be measured through various indicators and indices. One commonly used indicator is the Commitment of Traders (COT) report, which provides insights into the positions of different market participants, including commercial hedgers, speculators, and small traders. Changes in these positions can indicate shifts in market sentiment and potential price movements. Other sentiment indicators include surveys of investor sentiment and sentiment indices based on social media sentiment analysis. The volatility of oil prices driven by market sentiment can have significant implications for various stakeholders. For oil producers and companies in the energy sector, price volatility can impact profitability and investment decisions. High volatility can create uncertainty and make it challenging to plan for future projects. Consumers, on the other hand, may experience fluctuations in fuel prices, affecting their purchasing power and spending patterns. To manage the impact of market sentiment and oil price volatility, market participants employ various strategies. Hedging is one common approach used by oil producers, consumers, and investors to mitigate price risk. By entering into futures contracts or options, they can lock in prices and protect themselves from adverse price movements. Additionally, diversification of energy sources and investments can help reduce exposure to oil price volatility. In conclusion, market sentiment plays a crucial role in determining the volatility of oil prices. Investor perceptions of supply and demand dynamics, economic indicators, geopolitical events, and investor behavior all contribute to market sentiment. Understanding and analyzing market sentiment is essential for predicting and managing oil price movements. By considering these factors, stakeholders can make informed decisions and mitigate the impact of oil price volatility. 9.4 Regulation of speculation in oil markets. Speculation plays a significant role in the dynamics of oil prices. It involves the buying and selling of oil contracts with the expectation of making a profit from price fluctuations. While speculation can provide liquidity and efficiency to the market, it can also contribute to increased volatility and price distortions. To mitigate these risks, various regulatory measures have been implemented to oversee and control speculation in oil markets. The need for regulation. Speculation in oil markets can have both positive and negative effects. On one hand, it can enhance market liquidity, facilitate price discovery, and provide hedging opportunities for market participants. On the other hand, excessive speculation can lead to price distortions, increased volatility, and potential market manipulation. Therefore, it is crucial to strike a balance between allowing market participants to engage in legitimate speculation while preventing excessive speculation that could harm market stability. Regulatory bodies. Regulation of speculation in oil markets is primarily carried out by regulatory bodies such as the Commodity Futures Trading Commission, CFTC, in the United States and the Financial Conduct Authority, FCA, in the United Kingdom. These regulatory bodies have the authority to oversee and enforce rules and regulations related to commodity trading, including oil. Position limits. One of the key regulatory measures used to control speculation in oil markets is the imposition of position limits. Position limits restrict the maximum number of contracts that a market participant can hold in a particular commodity. These limits aim to prevent excessive concentration of positions and potential market manipulation by limiting the influence of individual traders or entities on prices. Position limits can be set in two ways: spot month limits and non-spot month limits. Spot month limits restrict the number of contracts that can be held during the month closest to delivery, while non-spot month limits apply to contracts for future delivery. By imposing position limits, regulators aim to ensure that no single market participant can exert undue influence on oil prices. Reporting requirements. Regulatory bodies also require market participants to report their positions and trading activities in oil markets. These reporting requirements help regulators monitor market activity, identify potential market abuses, and assess the overall market conditions. By having access to comprehensive and timely information, regulators can better understand the dynamics of oil markets and take appropriate actions to maintain market integrity. Margin requirements. Margin requirements are another regulatory tool used to manage speculation in oil markets. Margin refers to the collateral that traders must deposit to cover potential losses on their positions. Higher margin requirements can act as a deterrent to excessive speculation by increasing the cost of trading and reducing leverage. By setting margin requirements, regulators can ensure that market participants have sufficient financial resources to cover their positions and reduce the risk of default. This helps maintain market stability and prevents excessive speculation that could lead to price distortions. Market surveillance and enforcement. Regulatory bodies employ sophisticated surveillance systems to monitor trading activities in oil markets. These systems use advanced technologies to detect potential market abuses, such as manipulation, insider trading, or excessive speculation. By actively monitoring the market, regulators can identify irregularities and take appropriate enforcement actions to maintain market integrity. International cooperation. Given the global nature of oil markets, international cooperation is crucial in regulating speculation. Regulatory bodies from different countries collaborate and share information to ensure consistent oversight and enforcement across jurisdictions. This cooperation helps prevent regulatory arbitrage and ensures that market participants adhere to the same set of rules and regulations regardless of their location. Evaluating the effectiveness of regulation. The effectiveness of regulation in controlling speculation in oil markets is an ongoing subject of debate. Critics argue that regulation may hinder market efficiency and liquidity, while proponents argue that it is necessary to prevent excessive speculation and maintain market stability. To evaluate the effectiveness of regulation, regulators conduct regular assessments and reviews of market conditions. They analyze market data, monitor price movements, and assess the impact of regulatory measures on market dynamics. Based on these evaluations, regulators may make adjustments to existing regulations or introduce new measures to address emerging risks and challenges. Conclusion. Regulation of speculation in oil markets is essential to maintain market stability, prevent excessive speculation, and protect market participants from potential abuses. Position limits, reporting requirements, margin requirements, market surveillance, and international cooperation are some of the key regulatory tools used to oversee and control speculation. By striking a balance between allowing legitimate speculation and preventing market manipulation, regulators aim to ensure fair and transparent oil markets that benefit all participants. 10. Forecasting oil prices. 10.1 Methods and models for oil price forecasting. Forecasting oil prices is a complex task that requires a deep understanding of the various factors that influence the oil market. Oil price forecasting plays a crucial role in decision-making for businesses, governments, and investors, as it helps them anticipate future price movements and make informed choices. In this section, we will explore the different methods and models used for oil price forecasting. Historical analysis. One of the most common approaches to oil price forecasting is historical analysis. This method involves examining past price patterns and trends to identify potential future price movements. Analysts study historical data on oil prices, including supply and demand dynamics, geopolitical events, economic indicators, and market sentiment, to identify patterns and correlations. By analyzing historical data, analysts can identify recurring patterns and cycles in oil prices. For example, they may observe that oil prices tend to rise during periods of high global economic growth or during geopolitical tensions in oil-producing regions. This historical analysis can provide valuable insights into potential future price movements. Econometric models. Econometric models are another widely used method for oil price forecasting. These models use statistical techniques to analyze the relationship between oil prices and various economic variables. Econometric models typically incorporate factors such as global economic growth, oil supply and demand, inflation rates, interest rates, and exchange rates. One commonly used econometric model is the autoregressive integrated moving average, or RIMA model. RIMA models analyze the time series data of oil prices and identify patterns and trends. They can then forecast future price movements based on these patterns. RIMA models are particularly useful for short-term forecasting, as they can capture short-term fluctuations in oil prices. Another popular econometric model is the vector autoregression (VAR) model. VAR models analyze the relationship between multiple variables, such as oil prices, economic growth, and inflation rates. By considering the interdependencies between these variables, VAR models can provide more accurate forecasts of oil prices. Fundamental analysis. Fundamental analysis is a method that focuses on the underlying factors that drive oil prices. This approach involves analyzing supply and demand dynamics, geopolitical events, economic indicators, and other fundamental factors to forecast future price movements. Fundamental analysts study factors such as global oil production, consumption patterns, inventories, and geopolitical tensions to assess the future direction of oil prices. One key aspect of fundamental analysis is understanding the dynamics of the Organization of the Petroleum Exporting Countries (OPEC). OPEC plays a significant role in influencing oil prices through its production decisions. By analyzing OPEC's production levels, market participants can gain insights into potential future price movements. Sentiment analysis. Sentiment analysis is a relatively new approach to oil price forecasting that leverages the power of social media and news sentiment. This method involves analyzing social media posts, news articles, and other sources of information to gauge market sentiment and investor sentiment towards oil prices. By monitoring the sentiment of market participants, analysts can identify potential shifts in market sentiment that may impact oil prices. Sentiment analysis uses natural language processing and machine learning techniques to analyze large volumes of textual data. By identifying keywords, sentiment indicators, and patterns in the data, sentiment analysis models can provide insights into market sentiment and potential future price movements. Expert opinions. Expert opinions and surveys are also valuable tools for oil price forecasting. Analysts and industry experts provide their insights and predictions on future oil price movements based on their knowledge and experience. These expert opinions can provide valuable insights into market trends and potential price movements. Surveys of industry experts and market participants are also conducted to gather a consensus view on future oil prices. These surveys aggregate the opinions of a large number of experts and provide a collective forecast of future oil prices. While expert opinions are subjective and can vary, they offer valuable perspectives that can complement other forecasting methods. In conclusion, oil price forecasting involves a combination of methods and models that consider historical analysis, econometric models, fundamental analysis, sentiment analysis, and expert opinions. Each method has its strengths and limitations, and combining multiple approaches can provide a more comprehensive and accurate forecast. However, it is important to note that oil price forecasting is inherently challenging due to the complex and dynamic nature of the oil market. 10.2 Econometric analysis and oil price predictions. Econometric analysis plays a crucial role in understanding and predicting oil prices. By utilizing statistical models and economic theories, economists and analysts can analyze historical data and identify patterns and relationships that can help forecast future oil price movements. This section explores the concept of econometric analysis and its significance in predicting oil prices. The role of econometric analysis. Econometric analysis involves the application of statistical techniques to economic data to understand and quantify the relationships between different variables. In the context of oil prices, econometric models are used to examine the factors that influence oil price movements and to develop predictive models based on historical data. Econometric models typically consider a range of variables that affect oil prices, such as supply and demand dynamics, geopolitical factors, economic indicators, financial market trends, and environmental factors. By analyzing the historical relationships between these variables and oil prices, economists can develop models that capture the complex interactions and dynamics of the oil market. Time series analysis. One of the key techniques used in econometric analysis of oil prices is time series analysis. Time series analysis focuses on analyzing data collected over time to identify patterns, trends, and relationships. In the case of oil prices, Time series analysis helps economists understand the historical behavior of oil prices and develop models that can forecast future price movements. Time series models often incorporate various statistical techniques, such as autoregressive integrated moving average (ARIMA) models, autoregressive conditional heteroscedasticity (ARCH) models, and vector autoregression (VAR) models. These models take into account the past behavior of oil prices and other relevant variables to make predictions about future price movements. Factors considered in econometric models. Econometric models for oil price predictions consider a wide range of factors that influence oil prices. These factors can be broadly categorized into supply-side and demand-side variables. Supply-side variables include oil production levels, OPEC production decisions, non-OPEC production trends, geopolitical events affecting oil-producing regions, and technological advancements in oil extraction. These variables help capture the supply dynamics of the oil market and their impact on prices. Demand-side variables encompass factors such as global economic growth, industrial production levels, transportation sector demand, energy policies, and consumer behavior. These variables reflect the demand dynamics of the oil market and their influence on prices. Financial market variables, such as commodity prices, exchange rates, interest rates, and speculative trading activities, are also considered in econometric models. These variables capture the financial market dynamics and their impact on oil prices. Environmental factors, including environmental regulations, renewable energy adoption, and carbon pricing mechanisms, are increasingly being incorporated into econometric models. These variables reflect the growing importance of environmental considerations in shaping the future of oil prices. Limitations and challenges. While econometric analysis provides valuable insights into oil price predictions, it is important to acknowledge its limitations and challenges. Predicting oil prices accurately is a complex task due to the multitude of factors influencing the market and the inherent volatility of oil prices. One of the challenges in econometric analysis is the availability and quality of data. Oil price data can be subject to revisions, and obtaining accurate and consistent historical data can be challenging. Additionally, some variables, such as geopolitical events or technological advancements, are difficult to quantify and incorporate into models accurately. Another limitation is the assumption of stationary relationships between variables. Economic relationships can change over time, and the stability of these relationships is crucial for accurate predictions. Changes in market dynamics or structural shifts can render historical relationships less reliable for forecasting purposes. Furthermore, econometric models are based on historical data and assume that the future will resemble the past. However, unforeseen events, such as geopolitical conflicts or technological breakthroughs, can disrupt historical patterns and render predictions less accurate. Conclusion. Econometric analysis plays a vital role in understanding and predicting oil prices. By utilizing statistical models and economic theories, economists can analyze historical data and identify patterns and relationships that help forecast future oil price movements. Time series analysis, incorporating supply-side, demand-side, financial market, and environmental factors, provides valuable insights into the complex dynamics of the oil market. However, it is important to recognize the limitations and challenges associated with econometric analysis, including data availability, changing relationships, and the inherent uncertainty of future events. Despite these challenges, econometric analysis remains a valuable tool for policymakers, investors, and industry professionals seeking to navigate the volatile world of oil prices. 10.3 Expert opinions and oil price forecasts. Forecasting oil prices is a complex task that requires a deep understanding of various factors that influence the oil market. While there are several methods and models used for oil price forecasting, expert opinions play a crucial role in providing valuable insights and predictions. Experts in the field of energy economics, market analysis, and geopolitics closely monitor the oil market and offer their perspectives on future price movements. In this section, we will explore the importance of expert opinions in oil price forecasting and the challenges associated with it. The role of expert opinions. Expert opinions are highly sought after in the oil industry due to their ability to provide valuable insights into the complex dynamics of the market. These experts possess extensive knowledge and experience in analyzing various factors that influence oil prices, such as supply and demand fundamentals, geopolitical events, economic indicators, and market sentiment. Their expertise allows them to identify trends, patterns, and potential risks that can impact oil prices. One of the key advantages of expert opinions is their ability to provide a holistic view of the oil market. They consider a wide range of factors and their interdependencies, allowing them to assess the overall market conditions and make informed predictions. By analyzing historical data, market trends, and geopolitical developments, experts can identify potential drivers of oil price movements and provide forecasts based on their analysis. Sources of expert opinions. Expert opinions on oil price forecasts can be found in various sources, including research institutions, energy consulting firms, financial institutions, and government agencies. These organizations employ teams of experts who specialize in energy economics and market analysis. They conduct in-depth research, monitor market trends, and publish reports that include their assessments and predictions for oil prices. In addition to institutional sources, individual experts also contribute to the discourse on oil price forecasts. These experts may have extensive experience in the oil industry, academic backgrounds in energy economics, or a combination of both. They often share their insights through interviews, articles, and public speaking engagements, providing valuable perspectives on the future direction of oil prices. Factors considered by experts. When providing oil price forecasts, experts consider a wide range of factors that can influence the market. These factors include supply and demand dynamics. Experts closely analyze the balance between global oil supply and demand. They assess factors such as production levels, consumption patterns, inventories, and spare production capacity to determine the overall market conditions. Geopolitical events. Geopolitical events, such as conflicts, wars, sanctions, and political instability in oil-producing regions, can have a significant impact on oil prices. Experts monitor these events and assess their potential effects on supply disruptions and market sentiment. Economic indicators. Experts analyze global economic indicators, such as GDP growth, inflation rates, and interest rates, to understand the overall health of the global economy and its impact on oil demand. Technological advancements. The development and adoption of new technologies, such as renewable energy sources and energy-efficient technologies, can influence oil demand and prices. Experts assess the potential impact of these advancements on the future of oil prices. Market sentiment. Experts consider market sentiment and investor behavior when making oil price forecasts. They analyze factors such as speculative trading, investor confidence, and market reactions to news and events. Policy and regulation. Government policies and regulations, including energy subsidies, taxation, and environmental regulations, can affect oil prices. Experts evaluate the potential impact of these policies on the oil market. Challenges in oil price forecasting. While expert opinions provide valuable insights, there are several challenges associated with oil price forecasting. These challenges include uncertainty. The oil market is inherently volatile and subject to various uncertainties. Geopolitical events, unexpected supply disruptions, and changes in market dynamics can make accurate forecasting challenging. Complex interdependencies. The oil market is influenced by a wide range of interconnected factors. Understanding the complex interdependencies between these factors and accurately predicting their impact on oil prices is a complex task. Limited data availability. Some crucial data, such as production levels in certain countries or geopolitical developments, may not be readily available or transparent. This limited data availability can hinder the accuracy of oil price forecasts. Unforeseen events. Unforeseen events, such as natural disasters or political crises, can have a significant impact on oil prices. These events are difficult to predict, making it challenging to incorporate them into forecasting models. Market speculation. Speculative trading and market sentiment can introduce additional volatility to oil prices. The unpredictable nature of speculation makes it challenging to accurately forecast price movements. Despite these challenges, expert opinions remain valuable in understanding the future direction of oil prices. By considering a wide range of factors and leveraging their expertise, experts provide valuable insights that can assist market participants, policymakers, and investors in making informed decisions. In conclusion, expert opinions play a crucial role in oil price forecasting. These opinions provide valuable insights into the complex dynamics of the oil market and help in understanding the future direction of oil prices. While challenges exist in accurately predicting oil prices, expert opinions offer valuable perspectives that can assist in making informed decisions in the energy sector. 10.4 Challenges and limitations in oil price forecasting. Forecasting oil prices is a complex task that involves analyzing various factors and variables that influence the global oil market. While there have been significant advancements in the field of oil price forecasting, there are still several challenges and limitations that make accurate predictions difficult. In this section, we will explore some of these challenges and limitations. 1. Volatility and uncertainty. One of the primary challenges in oil price forecasting is the inherent volatility and uncertainty of the oil market. Oil prices are influenced by a wide range of factors, including geopolitical events, supply and demand dynamics, economic conditions, and market sentiment. These factors can change rapidly and unpredictably, making it challenging to accurately forecast future price movements. The oil market is also susceptible to sudden shocks and disruptions, such as natural disasters, political conflicts, and unexpected changes in production or consumption patterns. These events can have a significant impact on oil prices, making it difficult to anticipate and incorporate them into forecasting models. 2. Complex interactions and feedback loops. Another challenge in oil price forecasting is the complex interactions and feedback loops between different variables. For example, changes in oil prices can affect economic growth, which in turn influences oil demand. Similarly, geopolitical events can impact oil supply, which can then affect prices. These interdependencies make it challenging to isolate and accurately predict the impact of individual factors on oil prices. Moreover, the global oil market is interconnected, with various regions and countries influencing each other's supply and demand dynamics. Changes in production or consumption patterns in one part of the world can have ripple effects on prices globally. Forecasting models need to account for these complex interactions and feedback loops to provide accurate predictions. 3. Limited data availability and quality. Accurate forecasting requires reliable and comprehensive data. However, there are limitations in the availability and quality of data related to the oil market. Some countries may not disclose accurate information about their oil reserves, production levels, or consumption patterns. This lack of transparency can introduce biases and inaccuracies in forecasting models. Additionally, historical data may not always be a reliable indicator of future trends, especially in a rapidly changing market like oil. Economic, political, and technological developments can significantly alter the dynamics of the oil market, rendering historical data less relevant for forecasting purposes. 4. Assumptions and simplifications. Forecasting models often rely on assumptions and simplifications to make predictions. These assumptions may not always hold true in the real world, leading to inaccuracies in forecasts. For example, models may assume a stable relationship between oil prices and certain economic indicators, but this relationship can change over time. Simplifications in forecasting models can also overlook important factors or interactions that influence oil prices. For instance, models may not adequately account for the impact of technological advancements, regulatory changes, or shifts in consumer behavior on oil demand and prices. 5. Limited understanding of market psychology. Market sentiment and psychology play a crucial role in shaping oil prices. Investor perceptions, expectations, and emotions can drive significant price fluctuations, even in the absence of fundamental changes in supply and demand. However, capturing and quantifying market sentiment is challenging, as it is influenced by a wide range of factors, including media coverage, rumors, and speculative trading. Forecasting models often struggle to incorporate these psychological factors into their predictions, leading to limitations in accurately capturing short-term price movements driven by market sentiment. 6. Black swan events. Black swan events refer to rare and unexpected occurrences that have a severe impact on the market. These events are characterized by their unpredictability and the significant disruption they cause. Examples of black swan events in the oil market include the 1973 oil crisis, the Gulf War in 1990, and the global financial crisis in 2008. Forecasting models typically struggle to account for black swan events, as they are by nature unforeseen and often have far-reaching consequences. These events can lead to extreme price volatility and render traditional forecasting methods ineffective. 7. Regulatory and policy changes. Regulatory and policy changes can have a significant impact on oil prices. For example, the imposition of sanctions or embargoes on oil-producing countries can disrupt supply and lead to price spikes. Similarly, changes in energy policies, such as the promotion of renewable energy or the implementation of carbon pricing, can influence oil demand and prices. Forecasting models need to consider the potential impact of regulatory and policy changes on the oil market. However, accurately predicting the timing and magnitude of such changes can be challenging, as they are often influenced by political considerations and can be subject to delays or reversals. In conclusion, while significant progress has been made in oil price forecasting, there are still several challenges and limitations that need to be addressed. The inherent volatility and uncertainty of the oil market, complex interactions between variables, limited data availability and quality, assumptions and simplifications in forecasting models, limited understanding of market psychology, the occurrence of black swan events, and regulatory and policy changes all contribute to the difficulty of accurately predicting oil prices. Despite these challenges, ongoing research and advancements in forecasting techniques continue to improve our understanding of oil price dynamics and enhance the accuracy of predictions. 11. Impacts of oil price volatility. 11.1 Economic consequences of oil price volatility. Oil price volatility refers to the rapid and unpredictable fluctuations in the price of oil in the global market. These fluctuations can have significant economic consequences for both oil-producing and oil-consuming countries. In this section, we will explore the economic impacts of oil price volatility and how it affects various sectors of the economy. Impact on oil-producing countries. Oil price volatility can have both positive and negative effects on oil-producing countries. When oil prices are high and stable, these countries experience increased revenue and economic growth. They can invest in infrastructure development, social programs, and diversify their economies. However, when oil prices decline or become highly volatile, these countries face significant challenges. Government revenue. Oil exporting countries heavily rely on oil revenue to fund their budgets. When oil prices drop, government revenue decreases, leading to budget deficits and potential cuts in public spending. This can impact infrastructure projects, social welfare programs, and public services. Economic growth. Oil price volatility can hinder economic growth in oil-producing countries. Uncertainty in oil prices makes it difficult for businesses to plan and invest, leading to reduced economic activity. This can result in job losses, lower consumer spending, and a slowdown in overall economic growth. Investment and diversification. Oil price volatility can discourage foreign direct investment, FDI, in oil-producing countries. Investors may be hesitant to commit capital to projects in an uncertain market. Additionally, countries heavily dependent on oil revenue may struggle to diversify their economies, making them vulnerable to oil price fluctuations. Exchange rates. Oil price volatility can impact the exchange rates of oil-producing countries. When oil prices decline, the value of their currency may depreciate, making imports more expensive and potentially leading to inflation. This can further strain the economy and affect the purchasing power of individuals and businesses. Impact on oil-consuming countries. Oil price volatility also has significant economic consequences for oil-consuming countries. These countries heavily rely on oil for transportation, manufacturing, and energy production. Fluctuations in oil prices can affect various sectors of the economy in the following ways. Inflation and consumer spending. When oil prices rise, it leads to increased production costs for businesses. This can result in higher prices for goods and services, leading to inflation. Inflation erodes the purchasing power of consumers, reducing their disposable income and potentially dampening consumer spending. Transportation costs. Oil price volatility directly affects transportation costs, particularly for industries heavily reliant on fuel, such as airlines, shipping, and logistics. When oil prices rise, transportation costs increase, which can lead to higher prices for goods and services. This can impact businesses' profitability and potentially result in reduced economic activity. Trade balance. Oil importing countries may experience a deterioration in their trade balance when oil prices rise. Increased oil prices lead to higher import costs, which can outweigh the value of their exports. This can result in a trade deficit and put pressure on the country's currency exchange rate. Energy security. Oil price volatility can impact energy security for oil-consuming countries. Sudden disruptions in oil supply or significant price increases can create uncertainty and vulnerability in energy markets. Countries may need to rely on strategic reserves or diversify their energy sources to mitigate the risks associated with oil price volatility. Impact on global economy. Oil price volatility has broader implications for the global economy. As oil is a crucial input in various industries, fluctuations in oil prices can have ripple effects across different sectors and countries. Some key economic consequences include global economic growth. Oil price volatility can impact global economic growth. When oil prices rise, it increases production costs for businesses, leading to reduced profitability and potentially slowing down economic activity. This can have a cascading effect on other sectors and countries, impacting overall global economic growth. Income redistribution. Oil price volatility can lead to income redistribution between oil exporting and oil importing countries. When oil prices rise, oil exporting countries experience increased revenue, while oil importing countries face higher import costs. This can result in a transfer of wealth from oil importing to oil exporting countries. Financial markets. Oil price volatility can impact financial markets, particularly commodity markets and currencies. Traders and investors closely monitor oil prices as they can influence market sentiment and affect the value of commodities and currencies. Sharp fluctuations in oil prices can lead to increased market volatility and potentially impact investor confidence. Fiscal and monetary policies. Oil price volatility can pose challenges for fiscal and monetary policymakers. Governments may need to adjust their fiscal policies to manage budget deficits caused by declining oil revenues. Central banks may need to respond to inflationary pressures resulting from rising oil prices by adjusting interest rates or implementing other monetary measures. In conclusion, oil price volatility has significant economic consequences for both oil-producing and oil-consuming countries. It affects government revenue, economic growth, investment, exchange rates, inflation, transportation costs, trade balance, energy security, global economic growth, income redistribution, financial markets, and fiscal and monetary policies. Understanding and managing the impacts of oil price volatility is crucial for policymakers, businesses, and individuals to navigate the challenges and opportunities presented by the dynamic nature of the oil market. 11.2 Social and political effects of oil price fluctuations. Oil price fluctuations have far-reaching social and political effects that can significantly impact societies and governments around the world. The volatility of oil prices can create both positive and negative consequences, influencing various aspects of society, including economic stability, social welfare, political stability, and international relations. In this section, we will explore some of the key social and political effects of oil price fluctuations. Economic consequences. Oil price fluctuations have a direct impact on the global economy, affecting both oil-producing and oil-consuming countries. When oil prices rise, it leads to increased production costs for businesses and higher transportation costs for consumers. This can result in inflationary pressures, reduced consumer spending power, and decreased economic growth. Conversely, when oil prices fall, it can stimulate economic growth by reducing production costs and increasing consumer spending. The economic consequences of oil price fluctuations are particularly significant for oil-dependent economies. Countries heavily reliant on oil exports may experience severe economic downturns during periods of low oil prices, leading to budget deficits, unemployment, and social unrest. On the other hand, oil-importing countries can benefit from lower oil prices, as it reduces their energy costs and improves their trade balance. Social welfare. Oil price fluctuations can have a profound impact on social welfare, especially in developing countries where a significant portion of the population lives in poverty. When oil prices rise, the cost of essential goods and services, such as food, transportation, and heating, increases. This can disproportionately affect low-income households, leading to a decline in their standard of living and an increase in income inequality. Moreover, high oil prices can also lead to social unrest and protests, as people struggle to afford basic necessities. This was evident during the oil price spikes in the 1970s, which resulted in widespread social and political upheaval in many countries. Governments often face the challenge of managing social welfare programs and providing subsidies to mitigate the impact of high oil prices on vulnerable populations. Political stability. Oil price fluctuations can significantly impact political stability, particularly in countries heavily dependent on oil revenues. When oil prices are high, governments have more resources to invest in infrastructure development, social programs, and public services. This can help maintain political stability by satisfying the needs and demands of the population. However, during periods of low oil prices, governments may face significant challenges in meeting their financial obligations and delivering on their promises. This can lead to budget deficits, austerity measures, and social unrest. In some cases, governments may resort to borrowing or cutting public spending, which can further exacerbate social and political tensions. Furthermore, oil price fluctuations can also influence political dynamics at the international level. Oil-producing countries often have significant geopolitical influence due to their oil reserves. Changes in oil prices can impact the balance of power among nations, affecting alliances, conflicts, and diplomatic relations. Oil-importing countries may also face geopolitical challenges as they seek to secure reliable and affordable energy sources. International relations. Oil price fluctuations can have a profound impact on international relations, particularly between oil-producing and oil-consuming countries. The economic interdependence between these nations creates a complex web of relationships that can be influenced by oil price volatility. High oil prices can lead to increased tensions between oil-producing countries and oil-consuming nations. Oil-importing countries may feel the economic burden of high oil prices and may seek to diversify their energy sources or reduce their dependence on oil. This can lead to shifts in trade patterns, energy policies, and diplomatic relations. On the other hand, low oil prices can create opportunities for cooperation and collaboration between oil-producing and oil-consuming countries. Oil-importing nations may benefit from lower energy costs, while oil-producing countries may seek to maintain market share and stabilize prices through agreements and alliances. In conclusion, oil price fluctuations have significant social and political effects that extend beyond the economic realm. The volatility of oil prices can impact social welfare, political stability, and international relations. Governments and societies must navigate these effects and develop strategies to manage the social and political consequences of oil price fluctuations. 11.3 Environmental implications of oil price volatility. Oil price volatility not only has economic and social consequences but also significant environmental implications. Fluctuations in oil prices can have both positive and negative effects on the environment, depending on various factors such as the level of oil consumption, investment in renewable energy, and government policies. In this section, we will explore the environmental implications of oil price volatility and discuss the potential impacts on climate change, air quality, and the transition to sustainable energy sources. Climate change. One of the most pressing environmental concerns of our time is climate change, primarily driven by greenhouse gas emissions. The burning of fossil fuels, including oil, is a major contributor to these emissions. Oil price volatility can influence the rate of greenhouse gas emissions in several ways. During periods of high oil prices, there is often a greater incentive for oil companies to explore and extract oil from unconventional sources, such as oil sands and deepwater reserves. These extraction methods are typically more energy-intensive and have higher carbon emissions compared to conventional oil production. As a result, increased oil production during times of high prices can lead to a rise in greenhouse gas emissions, exacerbating climate change. Conversely, when oil prices are low, there may be a reduced economic incentive for investment in renewable energy sources. Lower oil prices can make fossil fuels more economically competitive, potentially slowing down the transition to cleaner energy alternatives. This can hinder efforts to reduce greenhouse gas emissions and mitigate climate change. Air quality. Oil price volatility can also impact air quality, particularly in urban areas heavily reliant on oil for transportation and energy generation. When oil prices are high, there is often a greater incentive for individuals and businesses to seek alternative energy sources and adopt more fuel-efficient technologies. This can lead to a reduction in air pollution and improved air quality. For example, high oil prices can drive the adoption of electric vehicles, EVs, and hybrid cars, which produce fewer emissions compared to traditional gasoline-powered vehicles. Additionally, industries may invest in cleaner technologies and energy-efficient practices to reduce their reliance on oil and lower their carbon footprint. On the other hand, during periods of low oil prices, there may be less motivation for individuals and businesses to invest in cleaner technologies or adopt energy-efficient practices. This can result in increased reliance on fossil fuels, leading to higher levels of air pollution and negative impacts on air quality. Transition to sustainable energy sources. Oil price volatility can influence the pace and direction of the transition to sustainable energy sources. High oil prices can incentivize governments, businesses, and individuals to invest in renewable energy technologies, such as solar and wind power. This can accelerate the shift away from fossil fuels and contribute to a more sustainable energy future. Moreover, during periods of high oil prices, governments may implement policies and regulations that promote renewable energy development and energy efficiency. These policies can create a favorable environment for the growth of renewable energy industries, leading to job creation and economic growth in the clean energy sector. Conversely, low oil prices can pose challenges to the transition to sustainable energy sources. When oil is cheap and readily available, there may be less urgency to invest in renewable energy technologies. This can slow down the development and deployment of clean energy solutions, hindering efforts to reduce greenhouse gas emissions and mitigate climate change. Conclusion. Oil price volatility has significant environmental implications, affecting climate change, air quality, and the transition to sustainable energy sources. While high oil prices can drive investment in renewable energy and cleaner technologies, low oil prices can hinder the transition to a more sustainable energy future. It is crucial for governments, businesses, and individuals to recognize the environmental consequences of oil price volatility and work towards long-term solutions that prioritize the reduction of greenhouse gas emissions and the promotion of clean energy alternatives. 11.4 Strategies for managing oil price volatility. Oil price volatility can have significant impacts on economies, industries, and consumers around the world. The unpredictable nature of oil prices makes it challenging for businesses and governments to plan and make informed decisions. However, there are several strategies that can be employed to manage and mitigate the effects of oil price volatility. In this section, we will explore some of these strategies. Diversification of energy sources. One of the most effective strategies for managing oil price volatility is to diversify energy sources. Over-reliance on oil as the primary energy source leaves economies vulnerable to price fluctuations. By diversifying the energy mix and promoting the use of alternative energy sources such as natural gas, renewables, and nuclear power, countries can reduce their dependence on oil and mitigate the impact of oil price volatility. Investing in renewable energy technologies, such as solar and wind power, can provide a stable and predictable source of energy that is not subject to the same price volatility as oil. Governments can incentivize the adoption of renewable energy through subsidies, tax credits, and favorable regulatory frameworks. By transitioning to cleaner and more sustainable energy sources, countries can reduce their exposure to oil price shocks and contribute to mitigating climate change. Strategic reserves. Another strategy for managing oil price volatility is the establishment of strategic oil reserves. These reserves are stockpiles of oil that can be used during times of supply disruptions or price spikes. By maintaining strategic reserves, countries can ensure a stable supply of oil and mitigate the impact of sudden price increases. Strategic reserves can be managed by governments or international organizations such as the International Energy Agency (IEA). These reserves act as a buffer against supply disruptions caused by geopolitical conflicts, natural disasters, or other unforeseen events. By releasing oil from strategic reserves during times of high prices, governments can help stabilize the market and prevent excessive price spikes. Hedging and risk management. Hedging is a financial strategy that can be used to manage the risk of oil price volatility. Hedging involves taking positions in financial instruments such as futures contracts or options that are linked to the price of oil. By entering into these contracts, businesses can protect themselves against adverse price movements. For example, an airline company may enter into a futures contract to buy oil at a predetermined price in the future. If the price of oil increases, the airline company can still purchase oil at the lower contracted price, thereby mitigating the impact of higher fuel costs. Similarly, oil producers can use hedging strategies to lock in prices for their future production, providing them with certainty and stability. Demand-side management. Demand-side management refers to strategies aimed at reducing the overall demand for oil. By implementing energy efficiency measures and promoting conservation, countries can reduce their reliance on oil and decrease their vulnerability to price volatility. This can be achieved through initiatives such as improving fuel efficiency standards for vehicles, promoting public transportation, and encouraging the use of electric vehicles. Government policies can play a crucial role in driving demand-side management efforts. For example, implementing fuel taxes or carbon pricing mechanisms can incentivize consumers to reduce their oil consumption. Additionally, investing in public transportation infrastructure and promoting alternative modes of transportation can help reduce the overall demand for oil. International cooperation and coordination. Given the global nature of the oil market, international cooperation and coordination are essential for managing oil price volatility effectively. Countries can work together to share information, coordinate policies, and establish mechanisms for collective action. International organizations such as OPEC and the IEA play a crucial role in facilitating cooperation among oil-producing and consuming countries. Through dialogue and collaboration, these organizations can help stabilize the market, address supply disruptions, and mitigate the impact of oil price volatility. Conclusion. Oil price volatility poses significant challenges for businesses, governments, and consumers. However, by implementing strategies such as diversifying energy sources, establishing strategic reserves, employing hedging and risk management techniques, promoting demand-side management, and fostering international cooperation, countries can effectively manage and mitigate the effects of oil price volatility. These strategies not only help reduce the economic and social impacts of oil price fluctuations but also contribute to a more sustainable and resilient energy future. By embracing cleaner and more diverse energy sources, countries can reduce their dependence on oil, mitigate climate change, and build more stable and prosperous economies. 12. The future of oil prices. 12.1 Trends and projections for oil prices. Oil prices have always been subject to fluctuations and volatility due to various factors such as supply and demand dynamics, geopolitical tensions, economic conditions, and market speculation. Understanding the trends and projections for oil prices is crucial for businesses, governments, and individuals who rely on oil for their operations and daily lives. Historical trends. To analyze the future of oil prices, it is essential to examine historical trends. Over the past few decades, oil prices have experienced significant fluctuations. In the 1970s, the oil crisis caused by the OPEC oil embargo led to a sharp increase in prices. In the 1980s and 1990s, prices remained relatively stable due to increased production from non-OPEC countries and technological advancements in extraction methods. However, the early 2000s witnessed a surge in oil prices, reaching record highs in 2008. This increase was driven by factors such as geopolitical tensions in the Middle East, growing global demand, and speculation in the financial markets. The subsequent global financial crisis in 2008 resulted in a sharp decline in oil prices. In recent years, oil prices have been characterized by volatility. The emergence of shale oil production in the United States, along with geopolitical conflicts in oil-producing regions, has contributed to price fluctuations. Additionally, the COVID-19 pandemic in 2020 caused a significant drop in oil demand, leading to a historic collapse in prices. Supply and demand dynamics. The future of oil prices is closely tied to the balance between supply and demand. As economies recover from the pandemic and global energy demand rebounds, oil prices are expected to rise. However, several factors can influence this trend. On the supply side, the actions of major oil-producing countries, particularly OPEC and its allies, play a crucial role. OPEC has historically adjusted its production levels to stabilize prices. The organization's decisions to increase or decrease production quotas can have a significant impact on oil prices. Additionally, the production capabilities of non-OPEC countries, such as the United States, Russia, and Canada, also influence global supply levels. On the demand side, economic growth, industrial activity, and transportation needs are key drivers. As economies expand, the demand for oil and petroleum products typically increases. However, the transition towards renewable energy sources and the adoption of electric vehicles could potentially reduce oil demand in the long term. Geopolitical factors. Geopolitical tensions and conflicts in oil-producing regions have always had a profound impact on oil prices. Any disruption in the supply chain due to political instability, wars, or sanctions can lead to price spikes. For example, conflicts in the Middle East, such as those in Iraq, Iran, and Syria, have historically caused oil price volatility. Moreover, geopolitical shifts can alter the dynamics of oil production and distribution. The emergence of new oil-producing countries or changes in political alliances can affect global supply levels and, consequently, prices. Additionally, the influence of major consumers, such as China and India, on the global oil market cannot be overlooked. Economic factors. Economic conditions and macroeconomic indicators also influence oil prices. Global economic growth, inflation rates, currency exchange rates, and interest rates all play a role in determining the future of oil prices. During periods of robust economic growth, oil demand tends to increase, putting upward pressure on prices. Conversely, economic downturns can lead to a decrease in oil demand and a subsequent decline in prices. Inflation can also impact oil prices, as higher inflation rates erode the purchasing power of currencies and increase the cost of oil production. Currency exchange rates are particularly important for oil importing countries. A weaker domestic currency can make oil imports more expensive, leading to higher prices for consumers. Interest rates, on the other hand, affect the cost of borrowing and investment, which can indirectly influence oil demand and prices. Technological advancements. Technological advancements in the oil industry can have a significant impact on future oil prices. Innovations in extraction techniques, such as hydraulic fracturing, fracking, and horizontal drilling, have unlocked vast reserves of shale oil and gas. This has increased global oil supply and reduced dependence on traditional oil-producing regions. Furthermore, advancements in renewable energy technologies and the increasing competitiveness of alternative energy sources could potentially reduce oil demand in the long run. The adoption of electric vehicles, improvements in battery technology, and the expansion of renewable energy infrastructure may lead to a decline in oil consumption, thereby affecting prices. Projections and uncertainties. Predicting the future of oil prices is a challenging task due to the complex interplay of various factors. However, experts and organizations make projections based on current trends and assumptions. According to the International Energy Agency (IEA), oil demand is expected to recover from the pandemic-induced slump and reach pre-crisis levels in the coming years. However, the pace of demand growth may vary depending on factors such as economic recovery, government policies, and technological advancements. The future of oil prices also depends on the commitment of countries to reduce greenhouse gas emissions and combat climate change. The transition towards sustainable energy sources and the implementation of carbon pricing mechanisms could potentially impact oil demand and prices. It is important to note that unforeseen events, such as geopolitical conflicts, natural disasters, or technological breakthroughs, can significantly alter oil price projections. Therefore, it is crucial to monitor market developments and adapt strategies accordingly to navigate the ever-changing landscape of oil prices. 12.2 Emerging technologies and their impact on oil prices. As the world continues to grapple with the challenges posed by climate change and the need for sustainable energy sources, emerging technologies are playing a crucial role in shaping the future of oil prices. These technologies are revolutionizing the energy landscape and have the potential to significantly impact the demand for and production of oil. In this section, we will explore some of the key emerging technologies and their potential impact on oil prices. Electric vehicles (EVs). One of the most significant emerging technologies in the transportation sector is the rise of electric vehicles (EVs). EVs are powered by electricity stored in batteries, eliminating the need for traditional fossil fuels like gasoline or diesel. The increasing adoption of EVs has the potential to reduce the demand for oil in the transportation sector, which is one of the largest consumers of petroleum products. As the technology behind EVs continues to improve, their cost is expected to decrease, making them more affordable and accessible to a wider range of consumers. This, in turn, could lead to a significant increase in the demand for EVs, further reducing the demand for oil. The International Energy Agency (IEA) predicts that by 2030, there could be over 130 million EVs on the road, which would have a substantial impact on oil consumption and, consequently, oil prices. Renewable energy sources. Another emerging technology that is reshaping the energy landscape is the rapid growth of renewable energy sources such as solar and wind power. These sources of energy are becoming increasingly cost-effective and are being deployed on a large scale around the world. The expansion of renewable energy infrastructure reduces the reliance on fossil fuels, including oil, for electricity generation. As the share of renewable energy in the global energy mix continues to grow, the demand for oil in the power generation sector is likely to decline. This shift towards cleaner and more sustainable energy sources could have a significant impact on oil prices, as the reduced demand for oil in the power sector would put downward pressure on prices. Energy storage technologies. The development of advanced energy storage technologies is another crucial factor that could impact oil prices. Energy storage systems, such as batteries, are essential for the efficient integration of intermittent renewable energy sources into the grid. These technologies enable the storage of excess energy generated during periods of high renewable energy production and its release during times of low production. The widespread adoption of energy storage technologies would enhance the reliability and stability of renewable energy sources, making them more viable alternatives to traditional fossil fuel-based power generation. This, in turn, could accelerate the transition away from oil and other fossil fuels, leading to a decrease in oil demand and potentially lower oil prices. Hydrogen fuel cells. Hydrogen fuel cells are another emerging technology that has the potential to impact oil prices. Fuel cells generate electricity by combining hydrogen and oxygen, producing only water vapor as a byproduct. Hydrogen can be produced from a variety of sources, including renewable energy, and can be used as a clean and efficient fuel for transportation and power generation. If hydrogen fuel cells become more widely adopted, they could significantly reduce the demand for oil in the transportation sector. Hydrogen-powered vehicles offer the advantage of longer driving ranges and shorter refueling times compared to electric vehicles, making them a potential alternative for certain applications. However, the widespread adoption of hydrogen fuel cells still faces challenges related to infrastructure development and cost-effectiveness. Carbon capture and storage (CCS). Carbon capture and storage (CCS) is a technology that aims to capture carbon dioxide emissions from power plants and industrial facilities and store them underground. CCS has the potential to reduce greenhouse gas emissions and mitigate climate change while allowing the continued use of fossil fuels, including oil. If CCS technologies become more widespread, they could help to reduce the carbon footprint of oil extraction and refining processes. This could potentially improve the environmental credentials of oil and make it more acceptable in a world increasingly concerned about climate change. However, the deployment of CCS technologies on a large scale still faces technical and economic challenges. In conclusion, emerging technologies such as electric vehicles, renewable energy sources, energy storage technologies, hydrogen fuel cells, and carbon capture and storage have the potential to significantly impact oil prices. These technologies are reshaping the energy landscape and reducing the dependence on oil for transportation and power generation. As these technologies continue to advance and become more cost-effective, the demand for oil is likely to decrease, putting downward pressure on oil prices. However, the pace and extent of these changes will depend on various factors, including government policies, technological advancements, and consumer preferences. 12.3 Geopolitical shifts and future oil price scenarios. Geopolitical shifts play a significant role in shaping the future of oil prices. The complex interplay between political events, conflicts, and international relations can have a profound impact on the global oil market. Understanding these geopolitical shifts is crucial for predicting future oil price scenarios and making informed decisions in the energy sector. One of the key geopolitical factors that can influence oil prices is political instability in oil-producing regions. When political unrest or regime changes occur in major oil-producing countries, it can disrupt oil production and supply chains, leading to price volatility. For example, the Arab Spring uprisings in 2011 resulted in significant disruptions to oil production in countries like Libya and Syria, causing oil prices to spike. Conflicts and wars in oil-producing regions also have a direct impact on oil prices. When armed conflicts break out in major oil-producing countries, such as Iraq or Nigeria, it can disrupt oil production and exports, leading to supply shortages and price increases. Additionally, geopolitical tensions between major oil-producing nations, such as the ongoing rivalry between Saudi Arabia and Iran, can create uncertainty in the market and contribute to price volatility. Sanctions and embargoes imposed on oil-producing countries can also affect oil prices. When major oil-producing nations, like Iran or Venezuela, face economic sanctions that restrict their ability to export oil, it can reduce global oil supply and drive prices higher. Conversely, when sanctions are lifted, as was the case with Iran in 2016, it can lead to an increase in oil supply and downward pressure on prices. Geographical challenges can also impact oil prices. Some oil-producing regions face unique geographical obstacles that can affect production and transportation costs. For example, offshore oil fields require expensive drilling and extraction techniques, which can increase production costs and influence oil prices. Similarly, landlocked oil-producing countries may face logistical challenges in transporting their oil to international markets, which can impact supply and prices. Climate change is another important factor that will shape the future of oil prices. As the world transitions towards cleaner and more sustainable energy sources, the demand for oil is expected to decline. This shift towards renewable energy and the increasing adoption of electric vehicles could significantly reduce global oil demand, leading to lower prices. Additionally, international efforts to mitigate climate change, such as carbon pricing or emissions regulations, may further impact the demand for oil and its price trajectory. Technological advancements also have the potential to influence oil prices in the future. Innovations in drilling techniques, such as hydraulic fracturing or shale oil extraction, have unlocked previously inaccessible oil reserves, increasing global oil supply. These technological advancements have the potential to offset declines in conventional oil production and influence future oil price scenarios. When considering future oil price scenarios, it is essential to analyze geopolitical shifts and their potential impact on the global oil market. Geopolitical events, such as political instability, conflicts, sanctions, and geographical challenges, can disrupt oil production and supply chains, leading to price volatility. Additionally, the transition towards renewable energy, climate change mitigation efforts, and technological advancements will shape the future demand and supply dynamics of the oil market. While it is challenging to predict specific future oil price scenarios due to the complex and interconnected nature of geopolitical factors, it is crucial to monitor and analyze these shifts to make informed decisions in the energy sector. By understanding the geopolitical landscape and its influence on oil prices, policymakers, investors, and industry stakeholders can better navigate the uncertainties and opportunities that lie ahead in the future of oil prices. 12.4 Sustainable Energy Transition and Oil Price Outlook. As the world grapples with the challenges of climate change and the need for sustainable energy sources, the transition towards renewable energy has gained significant momentum. This shift towards a more sustainable energy future has the potential to reshape the dynamics of oil prices in the long term. In this section, we will explore the implications of the sustainable energy transition on oil prices and provide an outlook for the future. The rise of renewable energy. Renewable energy sources such as solar, wind, hydro, and geothermal power have experienced remarkable growth in recent years. This surge in renewable energy capacity has been driven by advancements in technology, declining costs, and increasing awareness of the environmental impacts of fossil fuels. As renewable energy becomes more accessible and cost-effective, it is expected to play a larger role in meeting global energy demand. Impact on oil demand. One of the key factors influencing oil prices is the demand for petroleum products. As the world transitions towards renewable energy, the demand for oil is likely to decline. The transportation sector, which heavily relies on oil, is expected to undergo a significant transformation. The adoption of electric vehicles (EVs) and the development of efficient public transportation systems will reduce the reliance on oil for transportation purposes. Furthermore, the integration of renewable energy into the electricity grid will reduce the need for oil-based power generation. As more countries invest in renewable energy infrastructure, the demand for oil in the power sector is expected to decrease. This decline in oil demand from the transportation and power sectors will put downward pressure on oil prices. Geopolitical implications. The sustainable energy transition also has geopolitical implications for oil-producing countries. Nations heavily dependent on oil revenues may face economic challenges as the demand for oil decreases. These countries will need to diversify their economies and reduce their reliance on oil exports to mitigate the impact of declining oil prices. Additionally, geopolitical tensions related to oil-producing regions may ease as the world becomes less dependent on fossil fuels. The shift towards renewable energy reduces the strategic importance of oil-producing regions, potentially reducing conflicts and geopolitical instability. Price volatility and uncertainty. While the sustainable energy transition is expected to have a long-term impact on oil prices, short-term price volatility and uncertainty may persist. The transition process will take time, and the pace of adoption of renewable energy technologies may vary across countries. This variability in the transition timeline can lead to fluctuations in oil prices as the market adjusts to changing demand dynamics. Furthermore, the future of oil prices will also be influenced by various factors such as technological advancements, government policies, and global economic conditions. These factors can introduce additional uncertainty into the oil market, making it challenging to predict the exact trajectory of oil prices in the coming years. Oil price outlook. Given the complex interplay of factors influencing oil prices, it is difficult to provide a definitive outlook. However, it is clear that the sustainable energy transition will have a long-term impact on oil prices. As renewable energy becomes more prevalent, the demand for oil is expected to decline, putting downward pressure on prices. In the short term, oil prices may continue to experience volatility as the market adjusts to changing demand patterns and geopolitical shifts. However, over the long term, the transition towards renewable energy is likely to result in a more stable and sustainable energy landscape. It is important to note that while the sustainable energy transition presents opportunities for reducing greenhouse gas emissions and mitigating climate change, it also poses challenges for oil-producing countries and industries heavily reliant on oil. These stakeholders will need to adapt to the changing energy landscape and explore new avenues for growth and development. In conclusion, the sustainable energy transition is expected to reshape the dynamics of oil prices. The decline in oil demand from the transportation and power sectors, coupled with geopolitical shifts, will likely put downward pressure on oil prices in the long term. However, short-term volatility and uncertainty may persist as the world navigates the complexities of the energy transition. As we move towards a more sustainable future, the outlook for oil prices will be shaped by a combination of technological advancements, government policies, and global economic conditions.